Can you see my screen? Can you see my screen?
Yes, please.
Okay. Screen. All right then. Can you see my screen?
Yes, please.
Okay. Okay. Screen. All right then. Let's start with the principles of taxation for petroleum operations. Now, when it comes to petroleum operations, it starts with section 63. Are we okay? And this section explains the basic rules for taxing income from petroleum operations or oil and gas. Are we okay? Now it's streaming now on YouTube, so there's no need for me to even record this session. Okay, so you can rewatch it on YouTube. But however, I think this session will be very important. So yeah. So when it comes to the principles of petroleum operations, the same thing we use for separate petroleum operations. Now, what are the key points we need to know? The key point you need to know is that there's a special tax called the petroleum income tax, and it is charged on income earned from petroleum operations. And this tax is calculated every year using the tax rate in the first schedule. Are we okay? So if a company earns income from other businesses, that income is taxed under the normal income tax rules. Okay. Now every petroleum project is treated as what? A separate business for tax purposes. What is this concept called?
Fencing, separate.
What is it called? Ring fence.
Ring fence. Okay.
Ring fencing, where we treat it as a separate business for tax purposes. Now, the tax is also calculated separately for each petroleum project. What is that? Ring fencing. So, transactions between different petroleum projects or between a petroleum project and another business of the same company must use the arm's length prices. Do you remember? We said this yesterday. Do you remember? And moving an asset into or out of a petroleum project will also be treated as what? A disposal and an acquisition. You are buying and selling. Do you remember? So anytime you see these things that you are seeing here, anytime that you are doing petroleum operations or mineral operations, and they ask you for separate petroleum operations, after talking about that approved plan of development and those things, you have to come and talk about all these things. Do you get the idea? Do you get the idea? Because all these rules with what? The separate what? Petroleum operation principle. So this is what will fetch you the full 10 marks or the full 20 marks. And yesterday I taught you that if you are asked for petroleum operations, like separate petroleum operations, you please mute unless you have something to tell me. We are streaming on YouTube, so it will be professional. Otherwise, the background noises doesn't make it way. I beg you. So if you have something, then you rather talk, right? Rather than do you get it? So we are saying that treat every separate petroleum operation as a separate business. The taxes should be calculated separately. Transactions between different operations of the same person must use the arm's length principle. When you move an asset into or out of a petroleum project, it is treated as buying or selling that asset. And when several companies own the same petroleum right, each company will calculate their own taxable income separately. Can you see? So all these things, you see that it relates more to ring fencing. So anytime they ask you something about separate petroleum operation or ring fencing regarding petroleum operations, after you talk about the normal ring fencing rules, you must add this to get your full 10 marks. I hope it's not difficult to remember, right? Each should be a separate business. Therefore, taxes should be calculated separately. Any transactions between them should be dealt with at arm's length. When it is transfer of assets, it should be treated as an acquisition to the other person and what? A disposal to the other person. Is that not so? And when you move assets into and out, that's what I told you. And when several companies share the same petroleum right, they shall also what? Calculate their taxable income separately. Very easy, right? Who can summarize what I just said? And then petroleum taxes, interest, fines, and penalties must be paid in the currency that is stated in the petroleum agreement, or if it is in Ghana cedi. I get it. If there's no currency specified, then we pay in Ghana cedi. So what you should know, which is an easy reminder, is that each petroleum project stands on its own and pays its own tax. And that's the concept of ring fencing. Does that make sense? So I need somebody to summarize section 63 for me, and then we move to section 64. Yes. Waiting.
Yeah.
Mommy?
Okay, so for the section 63, we're talking about ring fencing, where each petroleum operation, well, apart from it being in the 63 from previous knowledge, each petroleum operation from separate processing facilities are treated as separate petroleum operation.
That one
So
is
for
mine.
those ones,
That one goes with mining. I beg you, don't confuse the two. So for
oh,
petroleum, I told you that it is at two levels. One is at the contract level and one is at the
and
field level.
yes,
Each petroleum right in itself is a separate operation. And even
yes,
within the petroleum right, if you have fields or different fields in there, which is what?
yes.
Production development area. That's what we call a field. Each production development area, just like we have for a mine, because you explore or dig development wells there. Okay, so each development well in itself is a field. That area you're exploiting is a field. And that field in itself, different fields are what, two different operations. But then when you were operating a field before the approval of your plan of development and after the approval of the plan of development, it means that it relates to the same operation. But when it comes to mining, it's the other way around. Mining, each mine, which now looks like the field we are seeing here, do you get it? It's also a separate
Mm,
operation. But when two or more mines, not petroleum operations, be careful. When two or more mines now share a processing facility, that is when they are treated as the same separate operation. Is your question answered now?
yes, I'm
So
fine.
now, after talking about that, that is when you now come and talk about the one we looked at. That each business shall be treated as separate. Their taxes will be calculated separately. Activities among those entities shall be treated as arm's length. Not so. And transfers of assets to and from the party should be treated as an acquisition and a disposal. If two or more people own the petroleum or mineral rights, they shall what? They shall treat their income or calculate their taxes and income separately, or their chargeable income separately. And that will give you the full mark for separate petroleum or separate mineral operations. But mommy, keep it up. You see, now that you have said it out, now you will never forget if it should come. Do you understand? So that's the rule.
Yes, thank
Good.
you.
So now let's look at separate petroleum operations. This is for petroleum, not minerals, right? We'll learn a lot of principles here, but we should cover this quickly so that we look at other important points. Now, this one, we explain what counts as a separate petroleum operation. Normally, each petroleum right, which we call the contract, right? The petroleum contract itself is treated as one separate petroleum operation. Okay, and also when a development plan is approved, activities before the approval and production activities, right, after approval are treated as the same operation. Does it make sense? I explained this yesterday. You remember that if you have dug one hole here, before and you were working on this before they approved and you are working on the same hole after approval, is it still not the same operation?
It is.
You were cooking jollof rice when your landlord came, you paused it and you went to take your tenancy agreement and you came back into the house to continue the jollof rice. Now the same jollof or not different jollof?
Same jollof.
Same jollof. But if you came back and you now set different fire and start using different ingredients, is it not a different thing altogether? That is exactly what we are saying here. So if I was having a petroleum field here, before approval and after approval, I was still doing activities here. It's the same operation. But if I went before approval and I came to start a different operation outside this one, then it's a separate operation. Does it make sense? Just like the way if you have a mine here and then you have another mine here, there are two separate operations. If I have a mine here and I go for reconnaissance license and later I get prospecting license on the same mine, is it not the same operation? Is it not the same operation?
It is.
So that's what the law is saying, right? So remember, separate petroleum operations are two levels. What are the two levels? I said
The
one is what?
contract
The
level and
contract
then the
level.
field level.
Meaning what? Each petroleum right itself is a separate
A
operation.
separate
And then the field level, which is the
operation.
production development area, right? And that
Yeah.
one, when a development plan is approved, activities before the approval and production activities I get it. And after the approval, are treated as the
Production.
same operation. And exploration outside the approved production area now becomes a new separate operation, just like I told you. Old jollof, new jollof. They were in there, the pan.
Sir, please, can you explain the contract
Old
level? Like,
jollof.
Contract level is each petroleum right. Your contract, you paid for a license. So simply each petroleum license in itself is a separate operation. Meboa. If you have 5 licenses, are they treated the same? We learned ring fencing. If you have 5
No,
licenses, are they the same? No.
no, they aren't.
Each
no.
license in itself, that's what we call the petroleum right or the contract. Each license in itself is a separate operation. So you treat them as such. Are you getting it?
Okay, thank you.
So one is here, one is at this place, one is at that place. Are you getting it? So each of them will be accounted for separately. And even within the contract, we have fields, right? And each field is also accounted for separately. Just like we saw for Sika Resources. You see, even though Sika Resources was one company, he had Omega Mine and what? Alpha Mine, and later bought Cornerstone Mine. But Omega Mine and Cornerstone Mine, Omega Mine and Alpha Mine were sharing a processing facility, right? So they were one entity. But you see, the Cornerstone Mine was a separate operation because it was not part of the processing facility. Did that make sense? So separate petroleum and separate mineral operations, you have to know it like the back of your hand. It's one of the key areas. So easy reminder, remember that a new development area can create a new tax project. That's all. Now let's look at the exploration and development operation. This is what creates capital allowances. I said this is what creates what?
Capital allowances.
Yes. So now this section explains how exploration costs are treated before production begins. And when we visit the regulations, it shows us something interesting. Now let's see. Why do we pool this? We said what? They are placed into one pool. So exploration and development costs, or all costs, whether revenue or capital expenditure, that we incur before commercial production begins. Are you getting it? All these costs, we put them into what? A single pool. There's no tax deduction or capital allowances allowed while exploration is taking place. Why? Who can tell me why? I explained this. Who can tell me why?
Sir,
Because
please,
there's
it's
no
because
revenue.
revenue has not exactly.
No,
Thank you. I told you tax still goes with what? The matching concept of accounting. Do you remember? So we must always match revenues against expenses. And if nothing has happened during that period, then why are we trying to take taxes or calculate taxes or calculate capital allowances? There's nothing. So we just keep putting them into a pool. So these costs do not become part of the cost of any asset yet, right? Because there should only be an asset to be used in the production of income. Does it make sense? Does it make sense?
Yes, sir, it does.
Because the definition of asset from the framework or the conceptual framework said it should bring future economic benefits. Now, if I haven't started production, that means the asset itself has no use. So it does not become the cost of any asset yet. So some expenses can also enter the pool. So if you have domestic expenses, excluded expenses, we cannot put them there. Okay, expenses that do not also meet legal requirements. So if you spend some money to smuggle goods, you smuggle some petroleum machinery to the country. You said? Oh, somebody is saying something. He just distorted me. Who was that? Someone.
So you were talking about smuggling goods.
I'm
Legal.
saying if somebody has smuggled some mining machinery or galamsey equipment into the country, it's an expense, right? But then, if it happened before production, we can still not include it because it does not meet legal requirements. So we cannot include it in the pool. Is it making sense? This, I know most of you have read it, but it didn't really make sense. That's why I'm breaking it down for you. And this is like the core to calculating capital allowance. I hope it makes sense. I hope it makes sense. So the pool balance which we have will be carried forward each year until the production starts. So somebody said something here that, do I have to do balance brought forward, balance carry forward every year for the pool? Well, if you do it, it's not wrong, but it's not necessary because production itself has not started. So why would you do brought forward, carry forward every year until, because the law says it's carried forward each year until production starts. Now, if the balance of that pool becomes negative, the negative amount becomes a taxable what? Income. That is only when production starts. Do you understand? So let's say that in the pool, right, I was having 200. Do you get it? I was having 200. Then I took up some machines out, right? I took out some machines out, like maybe the machines I took them out, or I disposed them off for 300. Now, this pool will stay in negative 100. Are you getting it? Until production commences. Then this negative 100 will now become an income when production what commences. Do you get it? So once our production starts, the entire pool that we have there now becomes what? A capital asset, because now production has started. So that income, that asset goes into the production of income or the generation of income. So now it can call itself an asset. So we now grant capital allowances. Relax for now. Don't stress. We'll go into the regulations and you understand it better, right? The Income Tax Act regulations, LI 244, specifically regulation 27. Okay, so we are going to go there and understand it better. But for now, are you okay with that? So the easy reminder is that before oil production starts, exploration costs are saved in one pool and then used what later. So if you have exploration and then development cost, these are some of the principles we use when we go to the distribution of crude oil. Yeah, Emmanuel, your hand is up.
Thank you, sir. Please, when the pool become negative, and for that matter, we have a taxable income. The taxable income is not subject to tax at the time that the pool becomes a negative.
That's what I'm saying. You don't add it to your chargeable income. You add it as an income when you are computing your chargeable income. It's like when you do normal capital allowance, right? The written down value of the pool was 5,000, and then you sold the asset for 6,000. There's a gain of 1,000. So don't you treat it as an income? But you don't. Where are you going to treat it when there's no income? It only should. That negative figure will also be carried forward until production has actually commenced. Do you get it? So that you have an income. You have to add it to other incomes and then less other expenses. Do you get it now?
Yeah, but the tax officers, the moment they found out that an item, a transaction has become, there's an income, they normally tax it. When it delays, they will subject it to interest.
And I'm saying that this income production has not commenced, so it is not a real income. Do you get it? It only becomes a real income when you are using that asset to produce something. Imagine you have a car there and you are not driving. Are you getting it? And there are taxes on cars. Who is going to hold you responsible for paying taxes on cars if you are a driver? Nobody, because you don't literally drive the car. Do you get the idea? So it only becomes taxable or chargeable when you are using it in producing income. Imagine if I bring machine from China and it's just at home. I don't use it. Do you expect me to pay taxes just because I have a machine? No. Even if I've given it to my neighbor and my neighbor has to pay me, for now, per their rule, because production has not commenced, that income will be in my books until production commences before I can add to my profits. Emmanuel, are you okay now?
Okay, it's right. All right, thank you.
You're welcome. So let's go to income for petroleum operations. This is where a lot of students don't get. Let's break it down. Then let's look at the expenses,
Hello.
other areas. Yes, boss.
So, in terms of the pre-production cost,
Yeah.
so I know that let's say exploration, development, they are capitalized, they are accumulated, and then when production starts, they be grant capital allowance.
Yeah.
How about other assets? Let's say
So
equipment.
thank you for asking that question. Okay. So before at 896, okay, mining and petroleum assets had their own treatment, which was different from what we normally charge. Are you getting it? Even if the assets were cars. So I know how the examiner can trick you. He will tell you that during those period, right? We'll come and solve a question right now, Vivendi. So during that period, okay, what happens is they bought some vehicles, they bought some machines, they bought some tractors, they bought a Toyota van, they bought this. Don't treat them as class 1, class 2, class 3, class 4. It's fake. They bought buildings, all are fake. Just group all and put it in the pool. and tax them at 20%, and grant capital allowance at 20%. Do you get it? All other assets are still petroleum assets. So they should still, or they should all go into that pool. Are we okay?
So if there was a disposal before production, we still can't deduct the revenue from the balance.
No, you can take it
Or you
out.
think that
No, you can take it out, but you can't charge it anywhere because the production has not begun. That was what I was saying. Raymond,
yes, sir. Well,
are we okay now?
yes.
All right. Good. So let's look at income from petroleum operations. Now, this section on section 66 explains what counts as petroleum income. Now, petroleum income includes one, sale of petroleum. This is what we normally know as what? Your barrels. Do you remember this? This is what we normally know as your barrels times what? The price per barrel. True or false? You have seen this before. Where
sir.
Yeah.
mostly somebody said no, sir.
Sir, we said true, sir.
Oh, okay. I thought you said no, sir. Do you get the whole idea? So we are saying that when it comes to the barrels of petroleum or the amount of petroleum in cubic tons that have been what? That have been won. Won means have been brought out from the ground or extracted. Okay. So these amounts that you have actually what? Won, you can what? You can start what? Getting the quantity and the barrels. It's part of your income. 2, insurance compensation for lost petroleum. Now, this one will also be subject to rules as per section 37. Yesterday, I explained consideration to you, that amount you get for owning an asset. So if I have petroleum from the ground and at the end of the day, it was what? Destroyed, and the insurance company gave me what? Some compensation for it. It becomes what? An income to me. Also, remember that sometimes some people come to do exploration in Ghana, right? So the geological exploration that they did, the geophysical studies, the use of the architects, the seismic data, and all those things, right? Assuming they couldn't find oil at that place, that doesn't mean someone else cannot find oil. So sometimes they can sell that data to someone who is coming there so that the person will not go and do a lot of work there. Do you get the idea? Do you get what I mean? So assuming they gave you this area to go and explore, okay, you went for the first 3 years, you didn't find oil, you filed for next extension period 2 years, then another extension period 2 years, right? That's 7 years total for exploration. The whole 7 years you didn't get oil, but you have done all your research. You have geological, geophysical course, all the people you pay, the geologists, the geophysicists, the seismic experts, the appraisal experts, the economists that you paid. They did a ton of research for you. So now that is an intangible asset that you have. Do you understand? Now, this data that you have, somebody who the government has also given this land or this part of the sea, it's also coming to explore, right? But because you have done your homework, you can sell that information to that person for a fee. And these things are very expensive because you spent a lot of money. Do you get it? Which to recoup your costs. So this is an example of a cost recovery, right? Where you end up what? Recovering costs for what? Information you obtained during the exploration phase. I hope it made sense to everyone.
Yes.
So it also qualifies as
Prof,
an yeah.
please,
I
can
can
it
hear
be
you.
paraphrased with sale of seismic data? Can it be paraphrased with sale of seismic data?
I don't understand what you mean.
As in sale of geological information, can we have a line like sale of seismic data? Should we
Of
treat
course,
it
why
the same
not? Yes, they are
line?
all there. So far as it's petroleum information, that's why they made it broad here. Seismic data is part of petroleum information. It could even be accounting information, customer information. It's still petroleum information. So assuming the people I sell my barrels to are in Saudi Arabia, and I decide to sell my leads to you, my customer list to you, it's still sale of petroleum information. It's an income to me.
Prof,
Yes, please.
if they say disposal of petroleum, does that mean it is a part of sales or?
Yes, if you dispose of petroleum, it means then the word disposal, realization, and sale are synonymous. I just say what on.
Okay.
Does it make
Alright.
sense?
Yes.
Please, I hope we are learning something. Take this thing serious. Oh. Like joke, like joke. These are the things that they examine in the full questions. But because people are only used to the question styles, they end up messing up because they don't know that it's actually these things they're examining. Also, when you sell your petroleum right, this one you're not selling petroleum itself, oh, you are selling the right, and we'll come and look at it in the regulation. The right or the license, let me say, you are selling off the petroleum right. And this one we have direct and indirect. You see, when you sell the right, it could be a Nikanso or not a Nikanso. A Nikanso means you are selling the right to somebody directly, and there will be capital gains on that, right? But then when you didn't sell the right, so you see, we have something we call direct assignment and then what? Indirect assignment. Have you heard it before?
Yes.
Yes.
Yes, please.
Explain to a 9-year-old. What's the difference between these two?
5%.
No. I think explain the
Direct is
meaning.
where you are
Another
entirely
third
giving,
party.
let's say, your mineral rights to a different party, and indirect is where the law sees a change in 5% or more in your mineral rights possession. Where
Okay. So this one is like you're explaining as SHS level or first degree level. I said explain to a 9-year-old. So, but you have done well. So when we say direct assignment, it means you are selling the thing itself. Do you understand? Look, you have a boutique, okay? You sell clothes. Then somebody comes and you sell the whole boutique to the person. Do you get the idea? So here you are selling the business itself to the person. But indirect assignment means I am not selling the boutique, but I'm selling all my clothes to you. All my clothes have changed by some percentage. Do you understand? Do you get it? So gradually it means my boutique is reducing. So it means that direct assignment, we are not selling the shares in the company. We are selling what? The company itself. By indirect assignment, we are selling the shares in the company. Do you get the difference?
Yes.
So here I'm giving you my business. By indirect assignment means that my shares are being disposed of. So to the Commissioner General, so far as shares are being disposed of, we have to get some sort of gains or what? Losses on realization. And that's what triggers this indirect assignment. Are we clear? And so far as there are gains and losses, it means that it could also trigger changes in ownership under Section 62, which we have to come and look at it in dire consequence because it's an anti-avoidance provision. I told you yesterday that oil and gas is all about anti-avoidance. So when you understand it very well, I mean, you wouldn't have any problem. Do you understand? Good. So we have seen different kinds of income. So far, how many types of income have we seen? Mention them. Income from petroleum operations.
Insurance. Income from the sale of the petroleum.
Income from sale of petroleum. 2.
Compensation.
Sale of data.
Sale of data. Okay.
Assignment of rights.
Assignment of. Are you sure? I said income.
Compensation.
It shouldn't be assignment. It should be disposal.
Disposal of right.
I don't like the word assignment. It makes it look like my lecturer B wants to give me assignment.
If you say gain from assignment,
Okay, then that one, yes, that's fine. I'll take it. Yes, please, I'm listening.
Surplus from the commissioning fund.
Surplus on decommissioning fund. Okay, we haven't gotten there, but I was asking what we've done so far.
So risk premium.
Yes, it's there, but we haven't done that. I just asked which ones have we looked at so far?
I've exhausted the list.
Oh yes.
insurance. Gain.
Please, are we okay?
Yes.
Obi, or question, the mommy? Who has a question? Or we can continue. Oh, why is this thing freezing? My computer is tired. Oh. Do you have any question for me?
No, sir.
All right. So what types of income were we looking at? We're looking at what? Sale of petroleum, insurance compensation, petroleum information, compensation. Are you getting it? Gains from selling petroleum rights, surplus from a decommissioning fund. Okay, we'll come and look at decommissioning fund and rehabilitation fund. If we have a reimbursement received under a sole risk agreement. Okay, so if you are operating as a sole risk operator, okay, so let's say that in the partnership that we have, right, our development and then maybe our exploration cost, I was the one who took everything up. Are you getting it? Then, if they have to reimburse me, are you getting it? That amount that they reimburse me becomes an income. So a sole risk, when we say sole risk agreement or sole risk income, we mean that money that you receive, right, that paid off what? All the costs of a petroleum project by itself when the other partners choose not to participate. So if they didn't participate in exploration, I took it up. Are you getting it? Then that is it. So when we say sole risk agreement, it happens when two or more companies own what? A petroleum operation together. And one of them decide not to pay for a particular operation, like drilling a new well or exploration, right? But the other company agrees to pay all the costs and take up the risk of that operation. Do you get it? Now, if that operation now is successful, listen, if the operation is successful, the companies that did not participate may later join the project. And to do this, they must repay the company that took the risk. Do you get it? So the repayment will usually involve what? Some sort of cost reimbursement. That's to repay the actual money sent and a premium, right? That's an extra amount that will be paid as a reward for taking the risk, which we call a sole risk premium. Did you get what sole risk means? Did it make sense? What did I say was a sole risk agreement?
So say it means two payments would be made, the premium and the normal
Yes.
payment.
Yes. So the repayment of your actual money that you spent and the extra amount, which is you nobody took the risk and you decided to take the risk. Don't jump into that hole. You jumped. Then you saw
So,
gold.
Prof,
Then all your friends want to share the gold. They must pay you something extra for that. Do you get the idea? Apart from your normal payment.
Thank you.
hello.
I can hear you, please.
Prof, so the main money that was used,
Both of them
which
and
of
the
them is an
premium
income?
are income. Both of them are income. So
And how
what
are
the
they treated?
reimbursement of hey, I'll not answer you. I said they are income, and you're asking me how they are. They
Yes,
how
they are
do you
income.
treat
And Prof, my confusion is that when we're doing the mining, you made
This one, we
mention
are not
that
doing
sole risk.
mining here. We are doing petroleum.
You matter.
See, this where you are getting your confusion is this. This reimbursement that I'm talking, it's not always in money. It can be in oil. Do you understand? And that is why if the gross barrels are produced, I told you that before, after you calculate royalty, you also have to calculate the sole risk premium. If they gave it to you as a percentage of the production barrels, the gross production, do you get it? But then once you get it and you multiply by the revenue per barrel or the price per barrel, it now becomes an income to you. Or that's why we
Yes.
call it distribution of crude oil. After it's distributed to you, is it not your income? Then sometimes they can give you in oil. Then the premium can be given in cash, or both of them can be given in cash or oil. It depends on the nature of the question. Does that make sense? Rayma, are you okay now?
Yeah, I'm fine.
All right. So assuming company A and company B own an oil block, and company B doesn't want to drill a new well, but company A drills the well alone and spends 50 million, right? And then the well later discovers oil. Company B later decides to participate in that well. Do you know what happens? Company B will now pay Company A maybe the 50 million to repay the drilling cost and 5 million maybe as a premium for taking the risk. So the 50 million is a reimbursement, which is a taxable petroleum income. I get, and the 5 million becomes a premium, which is still taxable petroleum income. So the total income this guy will include in his income will become the 55 million. Do you get it? So in simple terms, sole risk is when one company takes all the risk, and if the other partners later repay that company, there are two types of income you should be expecting: the one for cost reimbursement and the one for the premium. Do you understand?
So will the sole risk income taken from the gross or from the net?
I said it depends on the agreement. I have said it several times.
Yeah.
Agreement no better they obey you.
Okay.
If the question is silent, state your assumption and go with the way you treat the royalties, right? Because the person has taken the risk before. Do you get it? And that thing came out of it. But sometimes they will tell you that it should be shared this way. Can even be a percentage of each of the partners' revenue that will be distributed. The question will tell you how the sole risk premium should be treated and who took up the sole risk premium.
Okay. Thank you.
You're welcome. Now, any other income that is connected with petroleum operations, are you getting it? It's also what? Part of your petroleum income. So remember the various petroleum incomes, right? Now, there's a rule regarding the market value of petroleum, right? The selling price of the petroleum, which is the price per barrel we're talking about, must follow the petroleum agreement, and it cannot be lower than the fair market value. So this one, even in itself, is an anti-avoidance provision, but we hardly talk about it because we hardly go into petroleum. But then the commissioner makes sure that whatever you are doing should not be lower than the market value. Otherwise, you are not applying transfer pricing well, because related parties can sell it lower. Why? So that they will pay lesser taxes. True or false? Because if the thing is $40 per barrel and I sell it at what, $20 per barrel, yes, it's my own petroleum. I can sell it how I want. But if you do that, means that you are going to have less revenue and hence less taxes. True or false? Which constitute base erosion and profit shifting. So this is also another hidden anti-avoidance provision where the commissioner makes sure that any amount you are paying for petroleum or pricing for petroleum does not go below the arm's length price or the market price. So every income connected to a petroleum operation is taxable. Now let's go to where it becomes interesting. The deductions from petroleum operations. So in your petroleum operations, just like we saw for mining, your annual rental fees you pay. When we say annual rental fees, we mean what? Your surface rentals. Okay, royalties are allowable, capital allowances are allowable. When you contribute to decommissioning fund, are you getting it? They are allowable. Decommissioning expenses and then other allowable business expenses. We'll come and look at other expenses that are not deductible. Yes, Perpetual.
Prof, please, I have a question in relation to the selling price. So I saw a question where there was the average selling price to be $125, and then there was a hedged selling price for the government share, which was higher than the average selling price. In that case, which one are we supposed to use as the selling price in calculating the
Head
revenue?
selling price. The head selling price was just for government computation.
Okay, so it means that the hedge selling price will just be used for the government, and then the average will be used for the other contractors.
So this is what it means. It means that on the market, petroleum is sold for maybe $50 per barrel. But me, the government of Ghana, I'm saying that you pay me $45 for each of my revenue, because that's the agreement I've entered into with you. And that's how it's supposed to be.
Okay.
So when you see the average, it means that's the market price on the market. It means they've collected so many market values and they found the average, which is the arm's length price.
Oh, okay.
Does it make sense?
Yes, please. Thank you.
All right. So what are some of the expenses that cannot be deducted? Here is where I'm very concerned, right? So when you have research and what development costs.
No, Prof, please, for confirmation, is the annual rental fee the same as the surface rental charges, please?
Of course. And not only surface rental, it includes surface rentals.
Okay.
But surface rentals are the main ones. So you can rent machines from GMPC. It forms part of your annual rentals. Even if you have to rent labor,
Okay.
it's part of annual rental fees. Do you get the idea? So it includes surface rentals and
Okay. Yes,
that
I do.
rentals. Yeah. So Moko rente canopia is annual rental fees.
Thank you.
All right. So makes sense. I hope you remember the deductions.
What
Now,
about bonuses?
wait, I'm coming. I'm not done.
Hmm.
You said what about what?
Bonus.
Bonus is never an allowable deduction. Bonus is never an allowable deduction. But then, there are some petroleum agreements. You see, the whole thing, let me come practically, okay? So the whole thing is like this. The law says this, right? But I've seen some people who maybe because of how much they're investing in Ghana is so huge that Parliament itself comes in to grant them some other benefits. Do you understand? Every company is supposed to pay tax, but there are some companies in Ghana, because they are employing a larger portion of the population, they don't even pay tax. Because the government sort of has a stake. And even in our Exemptions Act, it is there. Look, assuming I'm coming to employ 90% of Ghanaians, and that was work that government was supposed to do, and now I'm doing it for government, they are not going to make me pay tax. And they realize that the business I'm doing is lucrative, it can help the economy. They will step in. So some companies, yes, I've seen scenarios where bonuses have, even though the rule is that bonuses are actually not what? Not supposed to be what? Deducted, but I've seen scenarios. But bonuses are never deducted, they are capital in nature. It doesn't matter whether it's production or what signature bonus. But the production, you see the way that, look, you have a car, right? And you replace the engine. What do? During the time you replace the engine, you add that to what? The pool. True or false?
True.
Good. But if it was paid before production began, all will be put into the single pool. But during production, you, as and when, do you get it? You capitalize it as and when it is incurred. Do you get it? Then it affects the pool. So each time you have a production bonus, you can create a separate pool for it and a grant capital allowance on it for the next 5 years. Do you
Okay.
understand? Good. But if you are doing a question, you can just go and add it to your development cost, or just say pre-production asset and post-production asset, and then do this one over 5 years. Maybe this one happened in year 3. So you take all the year 2 ones, divide by what? 3. Take this one and divide by 5, because this one is going for 5 years. The rest are going for 3 years remaining.
Okay.
Are we okay? Good.
Yes.
Hello, Prof.
Don't worry. If you
Please,
don't
the
understand, just
bonus
leave
here,
me. Okay. That's
the
production
bonus here
bonus.
says bonus paid to obtain petroleum rights. So I'm sure
Oh.
this will be before
Bonus
production.
paid to obtain petroleum rights is what we call a signature bonus. Signature bonus is a lump sum paid to obtain a petroleum right. That one there, you add it to your exploration costs. If you see it in a question, I said add it to
Okay.
what? Add it to what?
Exploration
cost
Exploration
and
cost.
capitalize.
Yes. So far as you ask to exploration cost, it means you've capitalized it already. Okay. Now, cost that you incur by breaking a petroleum agreement. So anytime you breach a petroleum agreement and you pay a penalty or you incur a cost, you cannot deduct it. It's something that what you breached the agreement, you could have avoided it. If there were penalties, interest, fines, all those things cannot be deducted. Are we okay? But here I'm interested in the research and development cost. You see, petroleum and mineral companies, okay, they do a lot of research. Okay, so if you just see research and development costs, it is not supposed to be allowed because there are rules for research and development in terms of the accounting in itself. So, what then happens with research and development? So, let's understand some few things when it comes to R&D. Now, in the context of section 67(2)(a) of petroleum operations, right, and even section 81(2) for mineral operations, R&D expenditure is not an allowable deduction when you are taxing income, when you are calculating your taxable income. However, Even though it is not allowed as a deduction, does not mean that expenditure disappears. It doesn't disappear. It depends on the type of expense. Now, for the purpose of our CIT exam, you need to remember that R&D cannot be deducted from petroleum or mineral income. It can also be included in the exploration of the prospecting expenditure or reconnaissance pool, unless it qualifies as exploration or prospecting expenses under the Act, which general ordinary R&D does not. Therefore, it does not reduce taxable income. So R&D, you normally exclude it. But you know why we are saying that? Because the Income Tax Act specifically disallows R&D deductions for petroleum and mineral operations. Why? Because these industries have their own special tax rules. Instead of giving maybe a separate deduction for R&D, the law provides relief through mechanisms like capital allowance. Are you getting it? Which compensates for that. Your exploration and development expenditure pools. I get it. Because if you do research, you know that mostly that research would have come before you produced. Meboa. Hello.
Hi.
If you have done research, most of the research is not the exploration and development.
Yeah.
Yeah, so that kind of research was already part of the pool. Any other research is not real. It means that it may be manipulated to take advantage. So the commissioner does not allow you to do that. So R&D is intentionally excluded from these special deductions. But for instance, if a mining company incurs prospecting costs of maybe 2 million, research laboratory costs of 300,000, are you getting it? The tax treatment is that the 2 million prospecting costs will go into prospecting expenditure pool, and the research costs are not deductible. They do not reduce taxable income in any way. Do you get it? But however, it can be part of that pool before production actually commenced. Does that make sense? So exploration finds the resource, development prepares to extract it. Research creates new knowledge. So under special petroleum and mining tax rules, exploration and development receive special tax treatment, but research expenditure is specifically disallowed as a deduction. Did that make sense? So please don't forget it. That's why I intentionally took my time to explain the rules around R&D. Contribution to decommissioning and provision for decommissioning. Well, you say how different is contribution to decommissioning and provision for decommissioning? Well, they are same and they are different. Let me explain. Now, your provision for decommissioning is how much you expect that you are going to dismantle your asset or restore the land back to its original position, right? After maybe the next 5 or 6 or 7 years. Let's say the next 25 years. Do you understand? That is how these things work. But your contribution is how much you contribute to achieve.
Okay, I'm muted.
Please, did we get it? So look, I have estimated I'll spend 37 million in the next 25 years. Do you get it? Or 37 billion in the next 35 years. That's my provision for decommissioning. But every year I must contribute for it to grow to what? To become that 37 billion. Do you get it? That now becomes what? The contribution into the decommissioning fund. Now, the whole thing is that this contribution that I'm contributing, if at the end of the day, it cost me 35 billion to actually restore the land, it means that even though my fund is showing what? 30, I contributed what? 37, but it actually cost me 35. Menya mfaswa na maboka. Menya mfaswa na maboka.
What boka?
Dabiti. I said that in the next 35 years, I'm going to spend 37 billion to restore the land. But now
Okay.
I actually spent 35. Menya mfaswa na maboka.
Why emphasize?
So there's a surplus of what, 2 billion, right? The law says that when this happens, there's a gain. You have to add it to your income. It's a petroleum income. That's why we said surplus in a decommissioning fund. Do you understand? The same way, if I estimated 37 billion after 35 years, and then at the end of the day, my actual cost was 39 billion. what has happened? That means that this decommissioning fund was inadequate to meet my actual decommissioning, right? So there's what? An inadequacy of what?
2 billion.
Now, this 2 billion definitely have to go and borrow from the bank to finance, right? The law says that this one too will be treated as what? An allowable expenditure. Do you get the whole rule? So if it's inadequate, it's an expense. If it's surplus, it's an income. That's all about decommissioning. And rehabilitation has the same rule. But rehabilitation is for mining. Makes sense? So the same way to, let's say that, this contribution, I'm not supposed to withdraw from it. That's one of the rules. Then maybe in year 20, some opportunity came up and I withdrew from this fund I'm contributing. Maybe I withdrew 1 billion to go and what? Buy a new rig. You have breached the terms of a decommissioning agreement. So this breach that you have done will make the income now taxable. Do you understand? Somebody said, can we talk about, but sole risk tax treatment, I've already treated. Sole risk is an income to the person. So it will end up being taxed at 35%. What tax treatment again about sole risk are you looking for? That's how we treat sole risk. I thought you didn't I? Didn't I? Didn't I teach you how to? We haven't solved the question, but have I not taught you how? Have I not mentioned how to treat sole risk?
It is an income.
Prof, you did, oh.
Someone said, what about the one paying? The ones paying, it is a cost to them. It is a cost to them. Okay, so now let's come and look at financial costs. Now, financial costs here are relevant financial costs, right? And mostly they are costs from hedging, right? So sometimes they include some sort of interest, but ignore interest. So financial costs other than interest, they can only be deducted against the financial gains. We did it yesterday. Do you remember?
Yes.
Yes. So far as the financial gain or the hedging income, the gain from hedging is, let's say, 20,000, and the hedging expense was 1 million. It means that we would what? We would say that our allowable what? Financial cost, relevant financial cost would be what? The 20,000. So the excess shall be carried forward what? For the next 5 years in the order in which the loss was incurred. So here, the relevant financial cost is always limited to the financial gain, and any excess above the gain shall be what? Disallowed and carried forward for 5 years in the order in which the loss was incurred. All right.
Yes.
I hope it makes sense. I hope it makes sense.
Yes, sir.
Okay, now let's talk about capital allowances. This is where I'm very, very much interested. When you are calculating capital allowance, right, it will include things like what? Your petroleum rights, your exploration pool when the production starts, your development infrastructure, and signing bonuses, which we call signature bonuses. Okay, and any other cost after production that deserves to be in a pool. Okay, so you see that the commissioner groups into pre-production pool and post-production pool, but it doesn't really matter so far as you know which one came in when, so that you know. So some questions, now that's what CIT is doing. They want to test your mind. Let's say that some assets came in pre-production, right? Look at this, and they were worth, let's say the whole pool was 10 billion. Now this 10 billion came in 20 what? Let's say 2019 is where we started production, right? And then the year 2021, we bought assets, right, which are post-production assets. They can list all for you. Machine, what. Now this is 20 billion, right, in 2021. Now, if they tell you to calculate capital allowance, what will you do? We know that this is the first time production commenced. So petroleum asset have how many years? They have how many years capital allowance?
5 years.
5 years. If you want, it's 20% straight line, meaning if you do 100 over 20, that is 5 years. So it has 5 years useful life. So that means the 10,000, the one that came in the single pool, I would have done 10,000 divided by what? Divided by 5, and that'll give me what? 2,000 per annum. True or false?
True.
Then this one, we are in 2021, meaning how many years is gone? 2019 is gone, 2020 is gone, And we are now in 2021. So how many years is gone? 2 years.
Two.
So I have how many years remaining? 3 years. So in that case, what I'm going to do is that this 20,000, what am I going to do to it?
Divided by 3.
No, I have fooled you. This one only happened in
Oh, you are
2020.
good.
This one too, we divide by 5.
5 years.
Five.
But then this was capital allowance in 2019. Now in 2022, capital allowance will be the same, right? Because it's straight line, 2,000 per annum, 2,000 per annum, 2,000 per annum. But in 2021, we have what? The old asset, which will now be what? The same 2,000 per annum plus. Are you getting it? If you don't have 2,000 per annum, we can get a written down value as at that date. So let's calculate it. Let's use this illustration to understand it well. And then we can take questions which have come in this nature for us to see how this thing actually works. I hope it makes sense. Musa, your hand is up.
Yeah,
Musa?
Prof.
Yeah,
Yeah, Prof.
I can hear you.
I want a clarification on the limitation on the finance cost.
Yeah.
So the explain the finance cost will match against the finance gain, and
Yes. Limited to the
in a
finance
period
gain.
where the finance cost. Yes.
Yes. But when the gain is
So,
more than the cost, the commission
normally,
allows you to set them off. When the gain is more than the cost, the commission allows you to set them off and get a net gain on hedging. Get a profit on hedging. But when the loss is more than the gain,
which will be taxable.
Of course, that's when the gain is more than the cost. That means there's a gain on hedging.
Okay.
So it will be taxed at 35%.
Okay. So
that's your income.
Okay. Okay. So my question is, let's assuming that this excess financial cost is carried forward to the next year. To the next year, there is no financial gain, but there is a profit. Mostly, like I think I asked this question yesterday. My understanding is that this gain should be carried forward for subsequent 5 years in the period where you make a gain. Is it a financial gain or profit? Come again.
When you make a profit. So in a period,
it's profit, not the financial gain.
So let me explain. Look, if this year your financial cost, okay, your financial gain was let's say 2 million, financial cost was what? 10 million. Okay, that means that the excess to carry forward is what? So let's say there is 20x1, right? That's 8 million, right? Now next year, and then let's say there was another financial gain and financial cost again. I get, and at the end of the day, there was a profit. You are going to do this assessment separately. So let's say this one financial gain was 3 million, but this was 5 million. That means there's also what? 2 million carried forward again, right? So each year is an independent assessment. Now look at what happens. Now let's say that this year too, there was what? There was not a profit, there was a loss. So we now go into the next year, which is maybe 20x or 3. Now in 20x3, look at what happens. If I take my profit, okay, if I take my profit, which was what? How much was that? Let's say the profits was 20 million. This 20 million, can it accommodate all these expenses? Yes, it can. So this one, we didn't have any profit that year, so we carried it forward. This one too. So this one has what? If we carry it forward to 2023, 2 years have already expired, right? This one, only 1 year has expired. True or false? True or false?
That's true. True.
So we just come and let's just like unrelieved losses. So we say financial cost what? Deduction. So we have the one from 20x1, which was 8 million, and the one from 20x2, which was what? 2 million. So all is what? 10 million, which now can be deducted from the profit, right? Which means the profit now becomes what? 10 million. So what it means is that if I should draft a schedule like we do in practical terms, we have what? The year, the financial cost, the amount utilized, okay, the remaining, and then the what? The year of expiry. Okay, so let's see. So this is what you are saying, that okay, if you take the year 20x1, the financial cost was what? It was 8 million, right? Was 8 million.
Yeah,
How
it
much
was
was
8 million.
utilized?
Yeah.
We're able to utilize the whole 8 million. How much is remaining? Nothing is remaining. It should have expired when 20x2, 20x3, 20x4, 20x5, 20x6. It should have expired in 20x6, right? Do you get the whole idea? Then you come to the one that
Yeah.
goes to 20x2. That one too was what? 2 million. I get it. How much was utilized? We were able to take all the 2 million from profit. I get it. Making 10 million. All right. How much is remaining?
Yes.
This one to nothing remained. No, so nothing remained.
Yes.
So that one to expire in 20x what? 7. So that's how we do schedule for the losses for each particular year. And this is practical. This is
Oh,
not just theory.
okay.
This is what we do. We attach this schedule and
Yes,
send it
yes,
to
yes.
GRE. Is your question answered?
Yes, actually, yeah, it's answered. It's confirmed the GRE schedule. Yesterday, I think that was how it was actually treated by the GRE. That was the opposition. Thank you.
All right. You see, tax is interesting. But me, I don't like tax. So let's continue. Okay, so someone said talk about how unrelieved loss is treated. That's how I've done it. These are all unrelieved losses. The word unrelieved means you have not deducted it yet. You have not relieved it. That's how we treat unrelieved losses. Carried forward for 5 years. In the order in which the loss was incurred. So you see that we treated this 8 million before we treated the 2 million. So this is what we mean by in the order in which the loss was incurred. So assuming this profit, okay, was just what? Was just 9 million. Thank you. So now what will happen? We cannot deduct this 10 million. We can only deduct what? 9 million. True or false? True or false? Then we'll have zero profit. True or false? But when we come to this schedule, you see 8 million was used completely from the last year first, right? Nothing remaining. But then here, the financial cost was 2 million, but we can only deduct 1 million. True or false? Remaining 1 million to carry forward to the next year. So it will keep going and be meeting profit. If it doesn't meet any profit until 2027, it expires. Do you get it? Makes sense. The same happens to losses from business.
Please, but if, please, if there's profit, if there's profit, then it would be set. It should be set off against the profit, right? You only carry it forward when there's no profit for that year.
You only carry it forward if there's either no profit or the profit was not enough to cover all. So this one, the profit could only cover 1 million of the 2022 one, could cover all of the 2021 loss. So all was gone. Now the 1 million out of the 2 million was what we utilized. So we still have 1 million to carry forward to the next year. If next year another financial cost rises again, I get in it. This 1 million will go first before the other one to go. So that's how you deal with it in the order in which the loss was incurred.
Yes, but if the profit is adequate and it can
It
be set,
swallows
it
all
can be
of them.
set off
Then,
against it.
of course, then it swallows all of them. That's all. So you see the first example, the profit was 2 million, but the two were 10 million. So it was able to swallow all of them, leaving a chargeable income which will now be taxed. You see why I don't like tax? Confusion near Basa. All right. So you see, questions are maybe Safi. Okay. So PD Limited, I get in it. Started operations, right? Or commercial production. So let's say he had commercial production in 20x what 9, okay, and had the following costs. I get it. The following costs. So we had what 20x1, okay, 20x1. We had what exploration costs. Okay, so let's say we had exploration costs, okay, of 20 billion. You have what 20x2. You have exploration cost, okay, exploration cost, which was also what 30 billion. Then you have 20x3. I get it to 20x6. You have development costs, okay. You have development cost of what 100 billion. Okay. Then you have what? Machines. 20 billion. Then you have vehicles, 120 billion. Okay. Vehicles and plants. Then in 20x7, you had interest on loan for rig, for oil rig, right? That is say 50 billion. Okay. So look at the information that I have given you. So 20x8 to 20x9. Okay, you have wages and salaries. Okay, you have wages and salaries. 185 billion. Okay. Then you have what? Sale of old vehicle. 30 billion. Okay. Then you now have 20x0. Okay, that's the next year. So they bought drilling equipment, right? So they bought drilling equipment. So I forgot signature bonus. So signature bonus. However, where I've put it is not good. So signature bonus is 350 billion. Okay, here. Then drilling, let's say drilling machine or drilling plant, that's 240 billion. Okay, so this is what we have. Then we have the same 20XO, that's 2010. They had machine and equipment. So we have machine and equipment for 60 billion, right? Then 20x1, that's 20y1, that's 2011, right? So 20y1, they had development or oil rig, right? So let's say oil rig, which is 500 billion. Okay. So this is the formation, and they said what? Compute the capital allowance for 20x9, 20xo, and 20y1. Do you understand? When I say y1, you understand, meaning 10 years interval. So that means 2009, 2010, 2011, or you can be 2019, 2020, 2021. It doesn't matter. Do you get the whole idea? So you see this question, if this thing should come now, a lot of students will be taken by surprise because they are not used to this type. They are used to the one that comes in the distribution of crude oil. Do you get it? But this one examines the real principles, which we are going to see in Vivendi Limited. I will show you and you'll be like, oh, okay, so you get the whole idea. It's just following the rules that the law puts in place. Does that make sense? Do you want to take a shot or you want to write it down? Let's compute capital allowance. So what rules? So this question that you see very simple like this, it's very funny that this thing can come for 20 marks or 15 or 10. Why? Because as you are explaining, as you are writing, you should also be explaining why you added this, why you added that. Are you getting it? Do you get the idea? So for me, I can decide because here there are no partners that I have to share between. I don't have to really segregate into exploration and development. The reason why usually we segregate into exploration and development costs is because you see the partners, if GIPC is part, GIPC does not contribute towards what? Development and the exploration cost. Do you remember? Does not contribute towards exploration, but contributes only towards development and the additional participating interest. True or false? That's why we usually separate the two. But here, they didn't tell us. They just gave us for PD Limited. That means there's the allocated one. Okay, so all we have to do is put them into a single pool. So do you know what you do? Are you all following? Do you know what you do?
Yes.
You are going to group these into pre-production, the one that came before production, I get it, and the ones that came after production. Makes sense?
Makes
When
sense,
did they
Prof.
start production? When did they start production? 20x9, right?
19.
So all these costs up to 2019, we are going to add all of them and put it in a pre-production pool. Can we do that? Please sum them up for me. I don't have time. So sum them from 20 billion, 30 billion, add everything. So we'll be working in thousands. So let's work it up. Please add all for me and let's see the total in our pre-production pool.
Prof, stand at one place.
I'm at one place. Oh.
Please scroll up.
I had 875 billion.
Carry on.
1705.
Where did you end? You should have ended at wages and salaries. So you know that.
Yep. I said I had 875 billion.
That's after you ended here.
Yeah,
confirmed.
Okay.
875.
Okay, so that means our pre-production asset. Let me do it on it. Okay. So solution, right?
875 billion.
Yeah, so we are going to say what? In accordance with what?
Relevant sections.
Yeah, you can say relevant section or section 65, right? Or what? Production,
pre-production.
Or pre-production costs.
you can say pre-production or all exploration development costs, right? Incurred
Before commencement of production.
or before commencement of what?
Commercial production.
Of production shall be put, right?
Shall be placed in a single pool.
Or placed in a single pool, right? In a single pool, right?
Pool, yeah.
Shown what? As shown below, right? So yeah, we are not interested in the capital allowance yet. So in that case, let's get the pre-production pool. Okay,
Yeah.
you said you already have it, right?
Yeah, 875 billion.
Okay, so written down value brought forward was how much?
875 billion.
875 billion, right?
Yeah.
And there was a sale, right? Sale of old vehicle. Oh?
Yes.
So there was a sale of old vehicle, which was what? Was 50 billion, right?
Prof, let's go up.
30 billion.
30 billion.
Yeah, 30 billion.
30 billion. Okay, so we take it out. What do we have?
845 billion.
But now we are in 20x9, right?
Right.
Year of assessment. Good. Okay, so 845 billion becomes like our depreciation basis. True or false? Okay, so now with grant capital allowance, you have to check how many days they operated in the basis period. I assume it's the whole year, 365, right? But this now becomes a cost. You know that. So we can just tax it at 20%. No, so which is the same as dividing by 5 years.
Yeah, so you get 169.
So this now gives us a written down value brought.
675. 676.
676.
Yes.
Okay, good. Now, because every year is supposed to be the same 169, you can just carry it forward, right? But then I want us to go the next year too, because they said we should calculate for 20x what? Because they said we should calculate for 20 what?
2020.
Yes,
2020.
in that case, let's go to 2020. Oh, when we go to 2020 year of assessment, now we'll have two types of assets. What do we have? We have the pre-production asset. True or false? The one that came during pre-production. That one we have the written down value to be what?
676.
676, right? So we bring this 676 billion. Okay. Now, do we have post-production? Yes, we do. Post-production, what asset came in? This one we didn't have any written down value, but we had additions. True or false?
True.
2020, what new asset came in?
40. Drilling plant.
Only drilling plant, right? The rest came in 2011. No, it was drilling plant and machine and equipment, right? Making what, 300 billion? Oh?
Yeah, 300.
So in that case, addition, 300 billion, working. Pre-production asset, right? What and what to go there? One, drilling plant. How much?
240.
240 billion. And then what? Machine.
Machine and equipment, 60.
50. Now making what?
300.
300 billion. We'll mark this working, right? So that's the 300 now goes into a capital allowance schedule as an addition, right? Okay.
Yes.
So that means this now becomes our depreciation basis, right?
Yes.
Good. So this depreciation basis will give us what? 676 what?
Plus 300.
And this one gives us 300, right? Okay,
Yes.
this one is new. Is it not new? So it
Yes.
still has 5 years. True or false?
True.
True. But since most of the time, what if this question started from 2020? It means that the capital allowance, you don't know what the cost was, right? So all you have to do is get capital allowance this way by taking the written down value divided by what? The remaining what? The remaining life. Do you get it? But since we already know the capital allowance was 169 billion, we can just take the 169 billion straight from the 676. But assuming you didn't know the cost, see how we'll get the same capital allowance again. Do 676. How many years have gone? Only 1 year. Or
Only one. Yeah.
only 1 year. So we are left with what? 4 years. Do it and let's see. Do 676 over 4. You get the same 169.
Yeah.
So it's literally the same. So if you knew the cost, then it's straightforward. But if you don't know the cost, you just have to take the written down value over the remaining life. Life, Dodo was saying, how much is left? Do you get it? So 676 over 4 years means I get the same 169, right? But this one, the capital allowance will be what? The 300 divided by what? Divided by 5. You see why it's not advisable to add all the assets? Why? Because some of them came at different times. Do you get it?
Yes.
This is a full question, no? Or because I've written it very small, so it doesn't look realistic. Shit. This is a 20 marker. I hope you are learning something. So what's the capital allowance?
So
60
capital
plus
allowance
169.
229.
No, this one will be what?
60.
60. Okay. So our total capital allowance will be what? Total. Let's
229.
create a total column. Let's create a total column here. Total. So our total capital allowance for that year becomes what?
229.
229, right? 229 billion for that year. And here it was
Yeah.
just 169, right? So let's go to 20. Let's get our written down values. So our written down value carried forward. So this gives us what? 676 minus 169.
$507.
Then 300 minus 60.
240.
Okay, so now which year are we going to?
2x1.
So 2x1 or 2011. Let's make it 2011. And people don't understand why it's 2i1 or 2. Let's just use 20. Okay, 2021, right? Rather, because we said 2019 to 2020. So 2021. So 2021, what do we bring? We bring our brought forward, right?
Yes.
Written down value brought forward 507. Then this one 240. What if within this year they said he transferred let's say 2/3 of his petroleum rights or 60% of his petroleum right to somebody? It means that you also have to take what? 60% of what? This one and transfer.
Yes.
Are you getting it? So if you take 60% of this and you transfer, your capital allowance will now be the 40% left over the remaining life. Very simple, right? That's all. If I tell you that in Kunim Petroleum Limited acquired 60% of my petroleum right, there's been change in ownership to me, right? I'll come and show you that. But however, you see this 507 that has happened. I'll take 60% of it, and that will give me what? I'll take it out, meaning I'm left with what? I'm only left with 40% of the 507, right? Which gives me what?
202.8.
So this 202.8, how many years have gone? 3 years, right?
Yes.
3, no, these 2 years have gone. So I'll now divide by 3 years remaining, and that becomes my new capital allowance for this asset. Then the other guy will also take the other aspect of the capital allowance just to get the gain or loss on realization.
Prof, can't you use the Excel to do it for us? This one, the arrangement, not all that clear.
How is it not that clear?
Well, this is better.
This is what I have done. And I enini. This is it. It's two separate assets. Asset A, which is this one, and asset B, which is this one. Two separate things. So I don't know why you said it's not clear. And I'm in segregated table here. So this is the table. Can you see now?
Yes.
Is it clear now?
Yes, please.
So that is it. This one has nothing to do with what we have here. So this is the table. Now in 2021, did any new asset come in? Yes, the oil rig, right? Now the post-production had how many years remaining?
Post-production 4 years.
No, not 4 years. So you remember that last year 2 years had already gone. This was year 1, right?
Okay.
1 year gone. Then we came to 2020, 2 years gone. So in 2021, how many years is gone? That's when the 3rd year will go, right? So here we have 3 years remaining because 2 years are already gone. Mebwa. So to get the capital allowance, you can literally divide this by what? How many years for this one is remaining?
3.
No, not 3. You know that for this one, the first year was this, second year was this, right? So 2 years gone. Okay, so we are left with what? 3 years, right? But this one, only 1 year is gone. So here we are left with what?
4.
4 years. Do you get it? However, you can just take 60. So 240 divided by 4, is it not 60? Yes, because we knew the cost. If we don't, then you divide by the remaining life. But then the addition, the capital allowance for the rig, the addition that came in would have been what? The rig was how much? 500 billion, right?
Yeah.
But that one has 5 years. So the capital allowance becomes what? 500 over 5 years. Do you get it? Then you come and add all of them together for that year, which becomes this one plus this one plus this one, becomes a new capital allowance for that year only. And this is where students get confused. So anytime you transfer, just divide by the remaining life to get the capital allowance for that portion of the business. Did it make sense?
Yes, please.
Are we sure it made sense? Are we sure it made sense?
Yes, it does.
Let's see if CIT has brought something like that before. Are you ready?
Yes, Prof.
Good. Why look at a bit of the anti-avoidance provision. So look at this question. Good. So Mabia Company Limited, an upstream petroleum operator, assigned its 80% equity interest to Mbora Limited in June 2023. 80% interest. Now, I want us to go and read the provision quickly under section 62 of the Income Tax Act. I said in that section what?
62.
Section 62 of the Income Tax Act. Very, very, very important for your exam. So let's go to section 62. 62, where are you? All right. So we're here. 62, change in ownership. So it says what? Where the underlying ownership of an entity changes by more than what? More than 50%. More than what? 50% at any time within a period of 3 years. But per the question we're doing, Bora assigned how much? He assigned 80%.
80.
So has it changed by more than 50% during 3 years? Yes. True or false?
True.
True.
So immediately this happens, the assets and liabilities of that entity immediately before the change have been deemed to be realized. So that means that if you have any assets and liabilities, right, immediately before this thing happens, the consideration received minus what? That's the market value. The asset would have been realized at their market value minus their cost to get any gain on realization, right? And added to the income of that company. Because you have changed ownership, you have lost control. This is subject to rules under section 47, meaning that if you change ownership and you retain at least 50% of your existing ownership, it will be exempt from tax. But where I'm buying 80% from you, it means you have lost your original business. You now have only 20%. Have you not lost ownership? You have lost. So there's been change in ownership. Okay, and this one ties into the indirect assignment. I'll come and explain. Do you get it? So we are saying that, okay, if there's been change in ownership, an entity that changes ownership in the manner referred to above shall not deduct any financial cost carried forward. You cannot deduct a loss, unrelieved loss. You cannot claim a bad debt deduction. You cannot carry back a loss under long-term contract. So this is an anti-avoidance provision. Stops people from taking advantage of what? This change in ownership thing. Why? These Lebanese companies will buy a company and just change the name. And that is why they brought these provisions, right, to cater for those things. Are you getting it? And where a change in ownership of the type referred to above occurs, I get it. The period before the change and the period after the change shall be treated as two separate years of assessment. So always change in ownership has three principles. One, immediately before the change, all assets and liabilities are deemed to be realized. Two, you cannot deduct what? Financial costs, losses, are you getting business losses or unrelieved losses. You cannot deduct bad debt. You cannot deduct contract losses, right? Then immediately before the period before the change and after the change shall be treated as two separate years of assessment. So you see that there are three major things in change in ownership. And this thing is one of the most important provisions in the Income Tax Act. This is realization of business when you sell a business. Do you understand? Good. So if we can go back to where we were. Good. So I think this one came in February, right? So the consideration received by Mabia Limited stood at 400 million. Can you see that? And then the cost of depreciable assets acquired in the relevant years are shown below. You see, they have 2022 assets. Do you see that? We have 2021 assets and we have 2020 assets. Can you see that? Meaning all of them came at different years. And what did we learn in capital allowance right now? What did we learn in capital allowance right now? That each asset has 5 years. So this asset that is in 2020, that is in 2020, that is in 2020. If we go to 2021 now, it will have 4 years. If we go to 2022 now, that asset, it will still exist, right? We will still have to do capital allowance for it, but it will now have how many years?
3 years.
3 years remaining. You get it?
Yeah.
Are you guys following me? And is it making sense?
Yes, Prof.
Yeah.
Yes, these are the technical areas that if you get, I'm sure oil and gas, you just go in and go and smile because these are areas that people find difficult to understand. But if you get it, hallelujah.
Amen.
All right. So, question. Do you have any question for me or we can do this question?
So please,
Me
can you
too,
go over the
mommy.
capital allowance for me? I don't still get it.
So let's do this one. You will get it. See, you see the way that when you are doing capital allowance for pool 5 asset or pool 4, each asset in itself has a different pool of its own, right? You can't go and add assets acquired this year to next year. Why? Because all of them are on straight line. Straight line means that this one, if you charge it this year, it means you have 4 years remaining. So if it is next year and you see, every year we account for depreciation. So this year, if I buy new asset, it's not only this year's asset depreciation I calculate. I calculate the last year's own too, because the last year's asset, I'm still using it. Mewa. So if last year I used it, this year, does it still have 5 years remaining or it has 4 years?
4 years.
4 years.
4 years, thank you. But then the new one I buy this year, does it have 4 years or it has the original 5 years?
5
Original.
years.
5 years. So you cannot add the two together. It means that this one depreciates it at 4 years and this one depreciates it using what?
Yes.
5 years. If we go to the next year again, the one that had 4 years will now have 3 years, and the one that last year we bought will now have 4 years. Oh,
Yeah.
does it make sense now?
Yeah.
The person who asked the question.
Yes, please.
Now.
It makes sense.
Okay. So now let's go and calculate capital allowances. It said compute the tax payable and capital allowance claimable by borrower. We cannot just calculate the tax payable, right?
Yes.
We need the
That's-
capital allowance to calculate the
yes.
tax payable. So in that case, let's see. The cost of the asset itself that was acquired. So we sold the whole petroleum operation, right? We sold 80% of the petroleum operation, right? Which was the 400 million. But then we need the cost of the assets. Okay, meaning we would have sold off all these assets too, right? But then if you are transferring 80%, it means you are transferring 80% of the written down values. True or false?
True.
True.
So we can go with a table, or you can simply say that, okay, so let me first go to what? My 2020 year of assessment. So in 2020 year of assessment, what asset did I have? I acquired an asset at cost of what?
The cost
At
of
cost of what?
250
250. Okay. So this 250 million, I get it. Me, I like to work in thousands so that the figures look. I like big figures. So I'm a big man. So I like big things. All right. So 250 million, right? Now I need capital allowance, which would have been 20%, or just taking what? This 250,000 divided by what? Divided by 5, right?
5.
That would have given me what?
50,000.
Mm-hmm. So that means written down value carried forward, which will go to which year? The next year, right? Would be 200,000. Okay.
200. Yeah.
Now, if I come to 2021 year of assessment, right? My capital allowance, I know that what? I'll have cost of how much?
Cost of 100,000.
Yes, so my cost, I'll have the 2021 asset of what? 250.
100.
No, 250. The 2021 asset will have cost of what? 250,000, right? And the 2022 asset will have cost of what? We can decide to separate it anyway. Each one should have its own pool. Do you get it?
Yeah.
Do you get it?
Yeah,
The assets we bought in 2020. No, listen, please take your time. The assets I bought in 2020, in 2021, wouldn't it still exist?
Yes.
Yeah, so in 20 yeah, so in 2020, in 2021, the 2020 asset will still be there. Mebwa.
Yeah.
And then the 2021 asset in itself will also be there. Or
yes.
Now giving us the total. But do we have 2022? Not yet. So written down value, we are only going to have the 2021 at 200,000. No, be so. 2021.
Yes, 200,000. Yes.
I can still bring the cost because it's straight line cost minus accumulated depreciation. That's the way I was going. But you let's go this way.
Very well, very well.
You get it. Now addition. Which one came in fresh?
2021.
The 2021 at 100,000.
Yeah, so the 2021 asset now came in fresh, right? At 100,000. So this one is 100,000. Now let's go to the capital allowance now. So in that case, what's our depreciation basis? So our depreciation basis, this one will still be 200,000, right?
Yes.
And this one will be 100,000. But their capital allowance computation will be different, right? So when we are getting our capital allowance,
yes, please.
The one that came in 2020, capital allowance will be what? The 200,000
over
by
4 years.
what? 4 years remaining.
Yes.
And the one that came in 2021, capital allowance will be what? The 100,000 divided by what?
5 years.
5 years remaining, because this is the year it came. You see why we are learning makes sense.
You are too fast, Prof.
Do you get it? The thing is, you have 5 years.
Yes,
if you go to the next year, it will reduce. So if you are doing capital allowance, divide by the remaining life. I gave you the formula, written down value over remaining life. So at the end, kita 5. First year, kita 5. Now you are in the second year. 1 year is gone. So remaining life, is it not 4? That's what I'm saying. Is it clear now?
Hello, Mr. Japan.
Is it clear now?
Yeah, it's okay, it's fine.
Good.
Yes,
So in that case,
please.
200 divided by 4, Ebenya saying for capital allowance
So
for this.
that maybe I answer.
That's still 50,000.
Yes, it will be the same. That's why I said so
About
far.
the simple
The cost
so
is the
can
same.
answer that one in my
Then this one is what? 20,000, right? It's
Yeah.
20,000.
Yeah.
It's 20,000. Okay, so let's get the written down value. Then the total capital allowance will now be what? 70,000. Or
Yeah.
for that year. Okay. So this one gives us 150,000, and this one gives us 80,000. No, be so.
Yeah.
Okay, so that becomes our written down value carried forward to the next year. Now let's go to the year what? 2020 what? 2022 year of assessment. 2022, we'll have 3 classes of assets. We'll have the 2020 asset in our books, we'll have the 2021 asset in our books, and we'll have the 2022 assets too that came before our total. Does it make sense?
Right.
Good. So written down value brought forward, we know that the one that came for 2020 was 150. The one that came from 2021 was 80. But 2022, there was no written down value, but we had addition, right? It was a cost to the pool. For fraud. True or false?
Yeah, true.
So how much came? 200,000.
200,000.
200,000. Okay. Now we need what? The depreciation basis. So what's our depreciation basis?
For the 2020, we divide by the remaining years.
Yeah. So in that
Which
case,
should be
this is
3.
150,000,
3 years
80,000, and then what?
divided by 3.
And then 200,000, right? Okay. But now our capital allowance, we have 3 different assets, right? The 2020
Yeah.
asset, we'll take our 150,000 divided by how many years remaining? 3 years.
3.
3 years.
One that came in 2021, we have what? 80,000 divided by how many years? 4 years. The one that came
4
in
years.
2022 is fresh. No, so that is
Yeah.
200,000 divided by what?
Divided by
5
5.
years.
Right.
Is this thing difficult?
No, it's not.
If you understand it, it's smooth.
Prof,
Yes, please.
you are computing capital allowance. Why
Mhm.
are you using depreciation basis?
Capital allowance, what is the name? It's called depreciation allowance. Capital allowance is depreciation, just from the taxman's perspective. If you are doing capital allowance, you are computing depreciation. Or you don't know?
I know, but use the right term. It's
That is the
capital
right term.
allowance.
The law calls it depreciation basis. This is the basis on which
This
we
is
are
taxation. It's taxation, so it's capital allowance.
This is the capital allowance. This is the capital allowance. That's why I've written CA. Capital allowance computation and NIA. But capital allowance, the commissioner doesn't even call it capital allowance. He calls it depreciation allowance. The name is no longer even capital allowance. It's called depreciation allowance. But however, the basis on which you depreciate the asset is what we call the depreciation basis. So you calculating capital allowance, you are still, the process is called depreciation, but the expense is called capital allowance. So the basis upon which you are depreciating is called the depreciation basis. You can't say capital allowance basis. It doesn't make sense. What are you doing? You are depreciating. Do you get it? Here is capital allowance. That's why I wrote CA. But the basis, check the practice note. It is depreciation basis. Everywhere you go in the world. It's not only Ghana. Because that is the base.
Yes, please.
Are we okay?
Okay, thank you.
You're welcome. So in that case, what do we get? This one gives us what?
50.
Okay. The next one?
40.
40. The next
20.
one?
Oh, no, this is
So the next is
it's
20,
20.
sir.
It's 20.
20. Okay. Then the next one?
This will be
40,000.
40.
Please, where you are written a 20, I think you should shift it down to the next line.
Oh, it doesn't really matter. You understand what I'm doing? I just want it to
I
be
understand. I understand. Okay, no problem.
Don't worry. It's just working. So you're just saying
Written down values, you have 100,000.
No, I mean I want the total capital allowance, 90 plus 20. It's 110,000, right?
110.
Okay, now give me the written down value. This is what we are going to transfer to that guy, right? So written down value carry forward.
We have 100,000.
100,000.
Mm-hmm.
60,000 and 160.
And 160.
And 160. Okay. Okay. Now, what's the total written down value that will be transferred to this guy?
So
20,000.
320.
Plus 60,000 plus what? 160,000. Meboa. Say a ton business. Yes, sir. So the total written down value will transfer to this guy will be how much? You said this is how much?
320.
320,000, right? But how much did we sell to the guy? How much was the transfer? Transfer to who? Mbora. Oh?
80%.
80%.
Mbora. So we'll transfer what? 80% of the cost. Because the revenue that came in was also 80% of the revenue. Meboa. So 80 against 80. So 80% of the 320, Bema is saying?
256,000.
256,000, right? And that becomes the cost of the assets transferred. Good. So now can we get gain or loss on disposal? Yes, we can. How much did we dispose it of for?
400,000.
Okay, so consideration received was what?
400.
Consideration received was 400 million. So hence $400,000. No, $400,000. That's a muye dubi. 400 million. No. So less what? The cost transferred, right? So we can say written down value transferred. How much was transferred? 80%, which was 256,000. No, be so. So we take it out. Did we have a gain on realization?
Yes, again.
Yeah.
Yes, we had a gain on realization
144.
of 144,000. Okay, good. But we said that if you're a company, you have to add the gain on realization to your income. Mebwa.
Yes.
So what's the name of the company? Mabia what? Mabia Limited. Then we say what? Computation of what? Computation chargeable income. And what? And tax payable. Mebwa.
Yeah.
Yeah, so let's get his chargeable income and tax payable. For which year of assessment? For
2023.
Yeah, a mistake. Only a mistake.
Yeah.
They transferred it in June. Oh.
June
That means
2023.
half year. So that means the one we did in 2020, the last year, 2022, we are supposed to halve each of these ones. It was transferred in June. Do you get it? So that means this would have been 25,000 times 6 on 12, 10,000 and 20,000. It doesn't matter. You understand, right? So all you have to do is do that one and then deduct it, get the figure and then take it out. The same thing. Doesn't really matter. But you understand how it is done, right? You get it? Or who doesn't get what I'm trying to say?
Yeah, but say why
Please,
should
I
we?
have a question.
Mm-hmm.
Yeah. So because it was disposed in June, are we going to do for January to May?
No problem. We just need. That means that thing only existed for 6 months. Yeah, January to June.
I think we should add additional 6 months rather.
To 2023, yeah.
So it
No,
was
we
in
have to add
2023.
6 months in addition.
Let me explain something to you. What we are saying is that this one is whatever we have done here is only for 2022, but just that the assets are named 2020, 2021, 2022. So here, all you have to do is half this one because at later of the half year, here we did a full year, but we don't need full year because it ended in June. So you just have to do 25,000, 10,000, and 20,000. That's all. The other half of the year is not there.
When your study table
June of which year?
2023.
Yes.
That means you have to
So we
put
have to
another
do
year
6
again.
months more.
You guys get me now?
Yes,
You
the
get me?
confusion was about the 2022 and 2023.
Yes,
in
I thought
2022
people say
so
yeah,
we have
So we have to do
computed to
another
year
year.
end of 22. So we have to do
Yes,
for
we have to
23,
do for
6 months.
23. Yes. You see how this question is interesting. I hope now your minds are opening on capital allowance for petroleum. Eh? You see, it's interesting. And now this is how CIT is going. They are testing capital allowance properly, not the basic ones that you have been getting. That one there is child's play.
Hello, Prof.
Yes, boss.
Please, so I'm just thinking about something. Once we were not given the basis period, can't we also write an assumption to mean that the basic period for this company runs from 1st July to 30th June?
Please
to
don't touch
avoid
it.
having
No. That one there, you will deviate. Anytime a question is silent and they don't give you basis period, always assume January to December. Is it clear?
Oh, okay.
Yes. I so be I catch us a royalty of 5%. Now what exam and say taking royalty of 15%. Hey, Chairman, we better go. You can state the assumption, but always go simpler, right? So that you don't complicate for it. Would have been simpler, but don't assume, right? That was when he sold. That means any question that is there and it is silent, it means that they use basis period of January to June. January to December, sorry. So 2023 year of assessment, that means we still have the same assets, right? True or false?
Yes.
Okay. So in that case, now we have written down values, right? We just bring them. This one will be 100,000, 60,000, and then what? 160,000. Good. Now, straightforward, there were no additions. So straightforward, I need capital allowance, right? Or, because there were no additions, it's still the same assets. Or, no be so. So in that case, for the 2020 assets, I'll just take the 100,000 divided by how many years? 2 years remaining.
5 times.
Is it 2 years? Times 6 on 12.
Yes.
Then, why did
How
I
are
say?
you?
Why did I say
I'm
6 on
fine.
12? This is capital
I'm
allowance. So
fine. How are you?
June, end
Eh?
of June. Hey, please, who is that?
What?
Hey, Mike. Mike, take it easy, we beg.
Prof, I hope if you go the route of 30 days as September and the rest of 365 till you get the same answer.
That's what I'm coming to do now. Okay. Capital allowance in Ghana, we don't use months, we use days. So I'm coming to see end of June. How many days? So we have 31 for January, 28 for February, 31 for March, 30 for April, 31 for May, and 30 for June. That's 181 days. So I'm going to do 181 out of 365 for each of them. So this one, the one in 2021 too will be what? 60,000 over, that one is 3 years remaining, right? Times the same 181 over 365. And this one, 2022, will also be 160,000 over what? That one has 4 years remaining, right? 4 years remaining times 181 over 365. Question a bit woman. Why is CIT for so much more than oil and gas, papa? As somebody. And I'm
Prof, where then yeah? Prof, where then yeah?
February 2025. The last question.
Oh.
I had 24 795, right?
794. Okay, we run. No problem.
The next one. I had 9918. And then the next one.
Oh. 9918.
19836, right? Okay, so now we get our What do we get as a written down value? At 30th June.
We have the first one, I think 75205.
Okay. Then the next one.
50082.
The next one.
140164.
What's the written down value? Total. So what's the total written down value?
265. 265451.
26545. Come in. 265
451.
265451. Okay, good. And what's our total capital allowance? That's the sum of all these three for that year. Let's just put it at the side. That's the sum of capital allowance for 2023 June. When we dispose of the right.
The total is 5454549.
54549. So 54549. Okay. So that's our total capital allowance for that year, right? Now what do we need? We need our what? Gain on what? Gain on realization, right? Okay, so what's the gain on realization? What's our consideration received for selling the 80%? So consideration received for disposing of the 80% of the business, right? That was what? 400 what? US
100.
dollars. Not so? 400 million. Okay. So since we have consideration for 80%, we also need written down value assigned for the 80%. Maybe.
Yeah.
So in that case, that gives us what? 80% of the
8%
total
of 265451.
451. Yeah.
212
361. Okay, good. So in that case, was there gain on disposal?
Yeah.
Yeah. Was a gain on realization. How much?
187
639.
187,639. Okay. So this is a gain on realization, but we have to go and add this gain to our income, right? Was there any other income Mabia received? There was none, right? So in that case, we need what? Mabia what? Limited. Computation of what? Chargeable income, right? So let's get his chargeable income. So what becomes Mabia Limited's chargeable income? So that's what? There's no other income apart from what? The gain on realization. Remember?
Yeah.
That was the only income he had, which was what? 187,639. Then we less what? Allowable deduction. The only allowable deductions we had in this question was what? Only capital allowance. Remember? As of now, we are standing at June 2023, and the only capital allowance in that year is 54549, right?
Right.
So we less than 54549. Kwabna, your hand is up. Let me finish. So that gives us our chargeable income. So what becomes our chargeable income now?
That's 133,090.
090. Okay, so now we tax thereon at what? 35%. And that gives us what?
46582.
Yeah, 46582. 46582. Okay, good. Yeah, Kwabna, your hand is up.
Prof, my issue is with the capital allowance, the written down value. I'm reading the LI 2244, and it's like we have to use the capital allowance, the written down at the beginning of the year that the right was sold.
Yeah,
Hello.
I understand. At
So
the beginning of the year,
the 6 months calculation that we were doing, it's not really part.
so that you are saying that per the regulations,
Yes,
we're
section
supposed
30.
okay, we are supposed to use the end of the
Written down value of the the beginning of the year that the right was sold. The beginning.
this ones. But that's what we did in the first instance, right?
Yes. So I'm looking at you were talking about some 5 months. That's what I'm saying. That one will not be considered. The 5 months in the year that we sold it in June.
Yeah.
So from January to June, that one will not be considered.
Please, any reason for that?
I understand.
What's the basis?
Section 30 of the LI 2244.
I understand. Do you know why? Because in Ghana, we grant full year capital allowance. So far as the business was, let me show you. So far as the business was in operation the whole year, you grant full year capital allowance. Okay. Let's look at regulation 30 then. 30. Okay. Disposal of petroleum rights. Today is like we are learning. For the purpose of subsection 2 of section 69, where 5% or more of the underlying ownership of an entity that holds petroleum rights in the country is disposed of, to determine the gain from the disposal, the written down value of the capital allowance of the entity at the beginning of the year in which its underlying ownership was disposed of shall be apportioned in proportion to the percentage of the underlying ownership disposed of, and deduct from the consideration deduct from the disposal or from the market value of the proportion of the right deemed to be disposed of, whichever is higher. So the start of the year, no. How did I treat ABS for coming? Start of the year, no. At the beginning of the year in which the underlying ownership is disposed of. Do you know when is the beginning of the year where the underlying ownership is disposed of? Is this 1st January or 1st July?
1st January.
July.
You remember that in line with section T62, we said every time there's been change in ownership, the period before the change and the period after the change shall be treated as 2 separate years of assessment too. That's also another issue. Oceana said, why dream, boy? You don't go and waste your time for some way. Just state your assumption and move. So, okay, if we are going with the start of the year where it took place, just taking the assets at the start of the year, which is the end of the previous basis period, and using it, I think it will even be easier. It will save us more room. Do you understand? Okay, so you state, if that is the case, you state the assumption and then you move that you're using the written down value at the start of the year. Is it clear? So that means that if we had gone, we wouldn't have even done the 2023 because the start of the year, this written down values is what we will add, which we had 320. Do you remember? Do you remember?
Yeah.
Yeah, so in that case, if that was the case, so our first computation was correct. So our gain on realization would have been taking the realized sum of the 400 and then taking the cost, which would have been 80% off the 320, right? And that would be what? That would be what? 256, right? Then that would have been a gain on what? On realization. Then once we go into the income, because this is only income, we now come and less what? The capital allowance from it. It's the idea. In exam, it won't come the same, but it's good we have had this clarification. Is it clear? So we have done capital allowance for petroleum. I think that was quite a number. Somebody said, Prof, where from 114,000? Oh, sorry, I didn't see you. 10 marks, yes. Now you do a lot of work. You have to speed up. Oh, they are young question mining capital allowance. Tin. Please don't be scared, eh? Not sure it gets, but at least it's an eye opener. So let's go and look for capital allowance on mining.
So, Prof, in effect,
Yes,
Prof.
where the
you dispose of
transfer is in the middle of the year, we shouldn't consider prorating.
No.
We should consider to the full year before the sale was made.
The start of the year, before the sale was made. Then you state the assumption. Even the prorating is
what is the assumption?
The assumption is that in Ghana we actually grant full year capital allowance. Okay, so it doesn't matter where the asset came in or the asset left. It's full year capital allowance. That's the assumption. The only time, you see, the reason why I was having a conflict with this is that the rules of cessation is that so far as the business has ceased, then that is when we do apportionment or the business commences, right? If it was a disposal of assets, then we would have still given full year capital allowance. But if it's a disposal of a right or the business in itself, okay, so the business may have several rights as well. So let's stick with the start of the year one. You state your assumption and move.
Yes,
But Prof, can't we use the B part, which says where part of the petroleum is assigned, the written down value of the capital allowance at the beginning of the year in which the petroleum rice
Let's
was
stick
assigned
to the
shall be
beginning of the
apportioned.
year. That's why I said let's stick to the beginning of the year
Okay.
one.
Okay.
So that we don't have to do any
Okay.
181 days over 365. That's what I mean. So let's not do like this one. If it's in 2023, any part of 2023, we'll use the values at the start of 2023 and apportion. Meaning that year, you know that in some accounting, they can tell you that during the year of disposal, there's no capital, there's no depreciation on the asset. True or false? It's the same rule here. So that means that we don't apportion the depreciation. We don't do any depreciation in the year of disposal. So as far as you are disposing of the rights this year, those assets, no capital allowances on them. You use the one at the start of the year.
Okay, Prof, but please, assuming it is not a right and it is an asset you are disposing of, that one too, will it be the cost base minus the consideration, or that one will be the written down value minus consideration?
It's the same thing.
It's the written down value.
Yes, because this is something you have used before. At the way you use that disposal of, you can't use cost because the depreciable asset. If it was a capital asset, we cannot use written down value. We'll have to use the cost. Do you understand? For instance, if it was land, you cannot put it in a pool, true or false? Until land, the cost, then one in the written down value. So land, you just take the cost against the realized sum. That's all. I hope that's fine.
Prof, no, please come again. No, with the assumption of if it is a capital asset. I was thinking.
No, listen. In our books or in tax, we have capital assets and we have depreciable assets. Depreciable assets, we only realize them by comparing the written down value in the pool, let's say pool 1, pool 2, against the consideration. Meboa. Is that not what you do? If you have an asset in pool 2 and you are disposing, don't you just take it out of the pool? That is it. But when you have land, do you do that?
Yes, the written down value.
You take the consideration received and less the cost of the asset. That's what we are saying. So capital asset will have a cost, not written down value.
Okay.
Do you get it? If you buy shares, can they have written down value? No. They're capital assets. So you take the realized sum and less the cost of the shares.
Okay.
We did that yesterday, right? Where I taught you realization. Yeah, so.
Yes, Prof, I have a question.
I'm
yes,
listening.
so, yes, I don't know, but you didn't really complete, but I'm just assuming that after we less the 256 from the 400 to get the gain, we less
We
capital allowance.
computed, it's the same thing we did here, just that now it has, after you take the consideration and less the cost, the 256, you get this gain. And that gain, so far as there's no other income, when you are comparing, you are computing the chargeable income, you take the gain or realization. And because the chargeable income is only the capital allowance is the only allowable deduction, you take it out and then you get your chargeable income. Do you get it? But now that year, we didn't consider any capital allowance for the rights assigned. Are you getting it? The only income we'll have is a gain on realization here. Do you understand?
Okay, so I'm just my question is based on I'm actually referring to the solution from the past question, and I just wanted to understand because in the solution they didn't deduct they just charged the 35% on the 144, which is the gain on the realization, without lessening the capital allowance.
That's why I'm saying that now that we are going to no, that's why I'm saying that now that we are going to use the written down value at the start of the year, there's no capital allowance again. See, capital allowance only happened when we computed depreciation or capital allowance for 2023. Now, if you are using the balances at the start of the year, is there any capital allowance in the first place? If you are using the balance at the start of 2023, would you have computed capital allowance?
No, no.
You wouldn't have computed capital allowance. So it means that whatever value you have here is what you have transferred. This figure that you have transferred, no. Are you getting it? Compared against the consideration, you just tax it at 35% because there's no capital allowance to net off against. Do you get it? So that is it. Before, because we did the apportionment, that's why we went to deduct capital allowance. But here, there's no capital allowance to deduct. Make sense?
All right, thank you.
Please, can we look at February 2026, question 1C?
This me, what will not come, I won't worry myself. Oh. I'm only interested in what you are going to learn. Question 1, what? C.
Prof, which one is coming in?
Question 1, what? C.
Yeah, question 1C.
And that one, you said February 2026.
Yes.
What came there?
Something about equity and the brothers.
Audio limited. You know, compute the value of equity after transaction, tax payable, and then the return available to owners. Acquired minimum of 25%. That's in the upstream.
Ade a yɛba bɛhyia no koraa mo ama yɛnhyia.
And at time I'll save.
Someone na moyɛɛyɛ.
Prof, the neighbor,
Prof,
Prof,
the question I asked earlier on, you didn't on the surface rental thing.
We will solve surface rental. I said, cool it down. Yeah.
There's a past question that has unitization with surface rental. So I
Don't
wanted.
worry. I said we will solve surface rental. Cool down. I know what we are doing. So please relax for me. Okay.
Yes, boss. Thank you.
What is relevant now? Hear me. Then I will now come and do distribution of crude oil and do surface rental and do unitization. Then we are good to go. Think capitalization put hear me. Any finance lease. I no can hear me pa. You get it. So cool down. I there for you. Why you dey fear?
we trust you. We trust you.
Every day in God is every day in victory. You will be fine.
Amen. Amen.
All right. Okay. Got it. Look at the nature of the way the question is. So, aha. Something like this. Oh, that's the idea, no. You can see Kanewu Mining Resources Limited on 1st January 2017 to mine gold, right, was incorporated then. And diamonds at Pristia in the western region of Ghana. I hope you can see my screen.
Yes, please.
Good.
Yes.
So
Various
Trinity, I
reconnaissance.
asked question.
Yes, but
You
it's
at
an
the other
ICA
side.
question.
Okay.
Now, you know that. So I won't say why. Various reconnaissance and prospecting activities took place from 2017 to 2019. So reconnaissance and prospecting is like what? Exploration and development. So these are all costs before what? Production commenced. True or false? So actual production started on 1st January 2020. So you can see that, right? So the following were the costs and revenue relative to reconnaissance and prospecting. So we can see that, right? Analyzing historical data, we can see all these costs. You are looking at all the costs, purchase of drilling machines up to 2019. So what do you have to do? We have to add. Right? The one that are sales, you have to what? Reduce them. Then they said the following transactions took place on 1st January 2020. That's when production commenced. The company received compensation of 3.5 from their insurers for destruction of some gold mine. What is that?
Prof, which one are we to add? Please, I didn't understand though.
Hey, I have taught you the concept already. I told you any cost before production commences are supposed to be placed in a single pool. So all the costs you have incurred during that period are all supposed to be put into a single pool. So add all of them. Or
Okay.
does it make sense? Uh-huh. So the company received compensation of 3.5 from their insurers for destruction of gold. So when you receive a compensation, what is it? Is it not an income?
Yeah, it is an income.
Mining and processing costs, including wages and salaries incurred during the year, was 123.45. What is this? Is it capital expenditure or revenue expenditure? Revenue expenditure. So we should expense it, right? Sale of gold and diamonds. What is that? Income. Okay. Ground rent paid to administrator of stool lands. What is that? Expense. Company undertook further research and development studies at this 374,300. Do we allow or disallow research? Disallow. Royalties amounting to 11,355,987 was paid to government. Allow or disallow? Allow. Royalties and allowable deduction. Okay. The company acquired a new mineral right at a cost of 5 million. This is a capital asset. Mewa. Capital allowance. Bonus payment in respect of the grant of the new mineral right was 300,000. What is this? Allow or disallow? Disallow. It's a capital asset, right? Legal and other professional fees paid with the respect of acquisition of the new right is 121,800. What is the legal fees? In respect of acquisition of a new right.
Yeah,
Allow or disallow?
I think we should allow.
Disallow Nikram, but this
Disallow.
Why are we disallowing legal
I
costs
think we
for
should
the
allow.
Separate mineral
This is a different separate mineral.
It's supposed to be capitalized or something.
Capitalize it.
No, ring fencing.
Ring fencing, separate mineral
It's a
operation.
separate mineral operation, so we disallow it.
You're right. Okay.
Store preparation and development cost paid was 884,300. The total cost of the store preparation and development incurred was 1,021,700. What is that? Development cost, right? So capital allowance expenditure. Total cost of business operating permits was 556,300. The amount includes provision of 400,000 for 2021.
Allowable.
The one that belongs, the provision is not realistic. It's an estimate. You have to take it out. Yes.
Check it out.
Other general and admin expenses totaled 194,671,100. This includes construction of a huge iron gate at the entrance of the mine for 41,600. Capital allowance expenditure, mewa.
Yes, but
Yes.
capital allowance will be for the 421,600.
Yeah, so you have to take it out of the 194,67100. No, so
Yes.
selling and distribution cost paid was 172,554,700. Allow or disallow?
Allow.
Allow. Okay. Finance charge of operations, including interest on loans and bank charges incurred, was 211,500,000.
Finance.
Allow or disallow? Finance cost. Allow. So the first question was to get the capital allowance, and then the next question was to get what? The chargeable income for the company.
Chargeable income.
Can we try this question?
Yeah.
Good.
But also.
But this question is too plenty to waste our time. So let's just go and look at the solution.
Next.
Yeah, Musa. But if you get something like this, you smile, okay? You're going to get something like this, so you smile. So how do you get the capital allowance? You are going to say that in accordance with what? Sections 80, yes?
I have to find out on something this mining. I was thinking that it will be included here. It keep coming. This over stripping?
Over stripping, overburden stripping.
Over stripping cost, yes, and then is it sinking cost or at what point is it an allowable cost and what point is it disallowed?
Musa, I'm coming. We will come there.
No, the cost for
they come. Don't worry. I there for you. It's in the regulations, okay? So let's do it once and for all so that we don't forget. And I'm saying. And I'm saying.
We are with you.
Let's do it once and for all.
Yeah.
Let's do it once and for all.
So let's just do it once and for all. Then we are gone. Okay. Now, you see, when we talk about waste removal, overburden stripping, and sham sinking, is that not what you are saying? Musa?
Yes, please. Yes, Prof. That's it. Exactly.
Waste removal, overburden stripping, and shaft sinking. Mama come and touch your macra. So first, we must understand what they are. Are you getting it? If we understand what they are, then we will know how to treat them. The law gives us how to treat them. So when we say waste removal, it is the process of removing rocks, soil, and other materials that do not contain valuable materials. Are you getting it? So that the miners can reach the mineral ore underneath. So imagine you want to dig gold buried underground. Okay, before reaching the gold, you must first remove the rocks, the sand, the clay, the soil. And these materials are called waste because they have no economic value. Does that make sense?
Yes, Prof. I'm with you.
Did you all get waste removal and the meaning?
Yes.
Say it in a sentence form for us so that we can write
Simplest
it.
form. Hey, I've explained. It's like noises at your background, so you are not listening to me. I said it is a process where you remove rocks and other materials that do not contain valuable materials before you reach the earth. Is this not simple? If I want to take the ground and get gold, the rocks, the sand, the clay, the soil that comes, which have no economic value, is called waste. Because unsanka gold no, ututu from a planty bibia. All the soil and the materials you meet, are they not waste?
Yeah,
Are they not waste? Do they have
are.
any economic value? They have none. That's why we call it waste removal. Do you get it? So that the rocks and the sand and the clay that you dig up before you reach the gold are the waste because they have no economic value. Does it make sense? Then when we talk about overburden stripping, overburden itself is the layer of soil the sand and the rock that lies on top of a mineral deposit. So you see, even though we are digging, okay, we'll reach a place where there's a layer of soil, hard soil, sand and rock that is on top of the gold we are looking for. So overburden stripping means that we remove that top layer to expose the valuable minerals below. So on the surface, right, we'll have the surface, then the soil, the rock, and the sand, are you getting it? Form a layer on top of the gold ore. We call it overburden. So stripping it off means removing the top layer to now expose the minerals to the surface. Do you get it? So the mining company must now remove the overburden before mining the gold. So first we remove the waste, then we now come and do what? Remove the overburden, which is called overburden stripping. Then now we have what? Shaft sinking. Shaft sinking means that we have a deep vertical tunnel that is dug into the ground so that the miners can now reach the underground materials after they've done the waste removal and the overburden stripping. So shaft sinking simply means constructing a deep tunnel. So when we have the ground surface, we'll now come and have what? The mining shaft. Then the gold deposit will come after we have done the waste removal and overburden stripping. So the cost of building the tunnel is what we call the shaft sinking cost. Can you see the thing? So before production starts, if the waste removal, overburden stripping, or shaft sinking is done before mining begins, the costs are capitalized. They are not deducted immediately. They become part of the cost of the mining project, right? The single pool. And the tax relief is received gradually through capital allowance when production commences. So for instance, if I spend 20 million removing overburden, I spend 50 million digging the mine shaft. Since production has not started, they are capitalized. But if you are looking at it during production, if the work helps the future miner, let's say that if I remove the waste today so that the miners can reach the next year's ore, we will capitalize the cost. But if the work only helps to extract today's ore, removing the waste so that the miners can dig today's gold, then you have to expense the cost immediately. So you deduct it in the current year. That's how we treat waste removal, overburden stripping, and then what? Shaft sinking cost. So the simple rule is this. If the cost helps to secure future production, you capitalize. If it only helps to secure current production, you expense it immediately. Do you get it? So if a gold mining company spends what? Removing overburden before the mine opens, you capitalize. If they remove waste to reach the gold that will be mined next year, what do we do? Do we capitalize or we expense?
Expense.
No. You are still not getting. I
Capitalize.
said
We
anything that will bring a
capitalize.
future
We
benefit.
capitalize it.
Today's gold. Capitalize it.
I said if it will bring you a benefit in the future, that is tomorrow, you still capitalize. Before production, capitalize. If it is going to be geared towards tomorrow, capitalize. If only is to be sold this year, expense. So let's go again. Removing overburden before the mine opens. Capitalize or expense?
Capitalize.
Removing waste to reach gold, that will be mined next year.
Capitalize.
Removing waste to reach gold, that will be sold this month. Expense. So that is the treatment of overburden stripping, waste removal, and sinking cost. Shaft sinking. Sorry. And 1 year.
But Prof, will the question give you these details, especially with the one that affects the current month and future?
Yes, they will. They will. Yes, definitely.
Okay.
Prof.
Okay.
Yes, please.
My question is, why is the overburden not a waste? Since it's also
a waste.
So why do we have why do you have waste as a separate?
Let me explain. Overburden in itself is a huge layer of rock which has some sort of economic value than the waste. Okay. Waste any value be overburden no yet to me ton. Yet to me the see dying. And on a tanya shile woman, you know shile. Or shire or whatever. The shile that the women are law, thank you. Overburden no.
Okay.
That's one fast war. That's why we separate the waste need as soon in fast war be.
Okay, it makes sense now.
Oil and gas, you see how practical it is. Yo. So how do we treat?
So, Prof, you know this app.
You said this what? Musa, it's like your network. Oh.
I said now the exam. Yeah, can you hear me now? Prof.
Hey, Musa,
yes,
I can hear
I'm saying
you.
that the examiners these days. Yes, I'm saying that the examiners these days, sometimes they bring it in the form of a calculation. Sometimes they ask of the tax implication of the overburden tripping. So in that case, you have to look at both before and after, right?
Of course.
Or during.
Of course.
Okay, thank you.
Do you get it? So before the mine opens,
Yes,
it will
yes.
form part of the single pool. Do you get it? When commercial production begins, and they tell you that overburden stripping cost, waste removal, or shaft sinking cost is for gold that will be mined in the subsequent year, then capitalize it and grant capital allowance on it in the pool. Do you get it? But if it is gold that will be relating to this particular year, then you have to expense it. Treat it as an allowable deduction. Make sense?
Sure.
Okay. Mpamucho sisi amu na amu yo okay. Nana bro. Are we fine?
Let's
Yeah.
go ahead.
Jose.
Let's go ahead.
Okay. So where were we supposed to go?
We can learn.
We were supposed to do something. No, Mire fear the call. Hey, you see confusion.
We are looking at the question.
Prof, we're solving the question. Oh.
Oh, that question we dealt with the full note. We worked with the footnotes and you understand how it works. I can't give you that
We are
question.
projecting the answers.
No. I won't. That question, if it comes, then you do it. I won't go through the solution again.
Hey.
Oh, you can do is the mining question that you may get. So if you go, you can do it. You know how to do the capital allowance. The ones that came before production commence, you put them into a single pool, right? The ones that came after, you know how to treat it. You divide by the remaining life. You know already. So why should I even stress? Let's go and do our surface renter and petroleum computation. Anna.
So I have a question.
Yeah.
What is the difference between the consumption linkage and backward linkage?
Consumption linkage and backward linkage. So you see, normally, the oil and gas sector links with the petroleum sector, the mineral sector, the timber sector. There are some linkages, right? We call them cross-sectorial linkages. Do you understand?
Yeah.
Yeah, so now, how does the petroleum consumption, in terms of how we work with petroleum, link with the mining? Okay, if it comes to the backward linkage, their acquisition, appraisal, development, extraction, do they follow the same processes? How are they linked? Do you get it?
So those ones, they are in relation to mining and petroleum.
Yes.
Not other industries, but mining and petroleum industry.
No, it can be across other industries too. That's why I'm saying that the consumption, the linkages are what we call cross-sector. Are you getting it? How does it relate to other sectors? So sometimes you call them cross-sector what? Linkages.
Linkages.
Do you understand?
Yeah.
Do you get what I mean?
Yes, sir.
You want it in detail? You want it in detail?
Yes, I asked the consumption linkage seems to be the same as the backward linkage under the production linkage. That's why I wanted some clarity on it.
So for instance, okay, you think they are the same, but they are not the same. Now, they are similar. However, when we talk about a backward linkage, okay, it will happen when the oil or mining industry buys goods and services from local businesses. Okay, this is where it focuses more on production and supply chains. So to create job by maybe increasing demand for local suppliers. When it comes to consumption linkages, you are looking at where workers and companies now spend their income they earn from the oil and mining sector on other goods and services. So this is more focused on spending and demand, right? Creating jobs by increasing demand for consumer goods and services, while the other one creates jobs by increasing demand for the local suppliers. Do you get the idea?
Oh, okay.
So for instance, when we talk about backward linkage, we are saying that, okay, this one will occur when the oil or mining companies purchase the income from the domestic businesses. Instead of importing everything, they buy locally. So example, if the oil company buys drilling equipment from GMPC or from a Ghanaian company, catering services from a local businesses, rent houses from these local real estate companies for their staff, security services from Ghanaians, transport services. You see, this is what we call backward integration. If you've done strategy before, you've seen it before. Uniforms made in Ghana. So the local businesses will now grow because of the oil industry. If it comes to mining, buying explosives, tires, fuel, machine repairs, uniforms, food for workers, construction materials, all these ones are purchased to support other industries. So this one normally creates local businesses, create jobs, develops local industries. And even reduces imports because we depend more on the local businesses. It keeps the money in Ghana.
Okay.
That's what we call backward linkage. It means the extractive industry buy goods and services from local suppliers. They are going back to the resource base. Some sort of backward integration. Consumption linkage will happen after people earn income from the oil or the mining. One, they haven't earned income is the oil or mining companies using local suppliers. Consumption means people have now worked in mining companies, from petroleum companies. They've earned money. Their salaries and the companies also spend their profits, which will increase demand in other sectors. Like if an oil worker earns 20,000 or 500,000 Ghana cedis, he will spend on food, rent, clothing, furniture, education. All those people those people offering those services are going to receive those things, hence developing the economy. So if
Because
a mining engineer now buys a house, he buys a car, he buys groceries, insurance, this will benefit real estate, the banks, the supermarkets, the restaurants. If they travel, the tourism industry will benefit.
so their purchasing power has increased, like something like
Of
that.
course. Which benefits other industries again.
Thank you.
Are we okay?
Yes,
All right. Someone said my screen is not showing.
Yes, it was off earlier.
That's because it was overburden stripping that was there.
And I was thinking.
So the overburden stripping, are we okay?
Yes, please. Yeah.
Okay. You're okay with the linkages. Okay, so let's go and do the we said we're going to look at which one, Kra? The surface rental and those things. Anna.
Yeah. The question with the unitization and redetermination.
Oh, we'll do it. We'll do it. Don't worry. I know your baby. Yeah, baby.
Okay.
Cisia.
Oh, today we didn't start early. We were supposed to start at 5, but we couldn't start early.
I didn't have this thing. I wasn't also home, Charlie. I didn't have a computer with me. I was in town. I'm a Drufi in them.
Sir, please go down a little.
I'm coming. Scroll down a little from where? I'm not showing anything that needs to be scrolled down. So why did you say I should scroll down?
I'm seeing regulation 31.
What has happened to regulation 31?
Yes, I want you to scroll down a little.
That's where it ends, so there's no scrolling down.
Prof, we can see during production, so we are sure that there will be after production also.
There's nothing there. I'm coming. Okay. Here we go again. We're stuck here with a friend. Don't worry, I'll come back there. It's not time for that, so let's just finish this one. It's like today we haven't learned to. Please read and let's go, eh? Question 1. Who is reading for me?
I'll read. So Mobicom Exploration Limited and Eastern Petroleum Limited are in discussion with the state of Ghana for acquisition of petroleum rights and concessions within the Cape 3 Points oil field. The partners hope to acquire an equal interest in the operation. The proposed operation is expected to occupy an area of 2,200 kilometers. The entity envisages a rental of the ground or surface at each phase of the operations, extending to the production phase, which the exploration and production team projects to last for a duration of 5 years, 3 years for exploration, 2 years for development, without any extension periods. The state of Ghana is to levy a royalty of 5%, acquire initial interest, additional participation interest, and corporate income tax. Required. You are required to estimate the total ground rental charges for the next 5 years of operations, as far as the above information may permit, for inclusion in the fiscal budget of the joint operators.
Is he understood? So, first of all, let's understand how ground rent works, or what we call surface rentals. Okay. Now, you see, this is the rent you pay to the government of Ghana for the rentals that you have. So, for the part of the land or sea that they've given you, right? And then the whole thing is that, you see, it depends on where you are in the phase. I said it depends on what?
Where you are in the phase.
Where you are in the phase.
Yes, and where you are determines how much you pay in terms of the rental. So in Ghana, you have maximum of 7 years to explore. What did I say?
Maximum of 7 years to explore.
Maximum of 7 years.
So after the 7 years, they would have taken all of the land from you. We call it relinquishment. You've heard relinquishment before. I believe when you watched my video, you understood what we meant by relinquishment.
Yes, please.
Yes, so please, if you haven't watched the playlist, make sure you watch it. It's just tomorrow. So you can just stick with the playlist till tomorrow. You get a lot to write tomorrow. Okay, so we are saying that you have a maximum of how many years to explore?
7 years. No,
Yes.
based on the question.
I said you have a maximum.
Okay.
Not the question I'm saying. I'm saying that in Ghana, you have a maximum of 7 years to
7
explore.
years.
Do you understand? So exploration,
Yes,
the maximum is 7.
Prof, is it to do exploration only?
Yes, only exploration. So there are 3
Oh,
phases
okay.
of exploration. I said there are what?
3 phases of exploration.
There are 3 phases of exploration that you pay rent for. So let me. So the first phase is what we call the initial exploration period, right? So the initial exploration period is the first 3 years. What did I say?
Initial exploration period is first 3 years.
Now, this first 3-year period, right? If you are there, you pay $30 per square kilometer. Do you understand? As rental. Make sense?
Yes, please.
Now, during this period, assuming you didn't find oil, before those one, then you apply for second extension. Now, first extension. The first extension is the next 2 years. During that next 2 years, no, they will take a portion of the land from you. Most of the time, forget that part, but they take a portion of the land from you because if this part you didn't see oil, why should we still give you that land? Do you understand? Maybe let someone also come and try their luck. Do you understand how it works? That will try your luck, and don't we take a portion from you and give to someone else to try? Does it make sense?
Yes.
Yes. So
Yes, please.
exploration period 3 years, you pay $30 per square meters. Now, when you go to the first extension period, that's the next one, 2 years. Do you understand? So the next 2 years, you say Charlie Aquay still the near thing. $50 per square kilometer, man. Do you understand? Now, during this period too, if still
Prof, please, I think your voice is a bit down. I don't know if
my
it's just me.
voice is down.
Yes, it's better now.
It
Initially,
was,
it was
yes.
down.
It's
It
better
was
now.
down.
It's better now.
Maybe I was hungry then. So 3, we have the second extension period. Maybe still you say you there, you no agree. Before still now you try again. Then you go for the last phase. Okay. Which is the next 2 years. But then you will now be paying $75 per square kilometer. Not meter. Oh, the land is giving in kilometers. So square meter, the end there, nobody will come to Ghana. You understand? So you said you have a maximum of what, 7 years? No, be so. So the 7 years is broken into what, 3 phases. The initial exploration period of 3 years, where you pay $30 per square kilometer. The first extension period of 2 years, where you pay $50 per square kilometer. And the second extension period of another 2 years, where you pay $75 per square kilometer. So based on the question, it is a question that is going to tell you where they are. Do you get it? So what if I told you that a company did 4 years exploration and then what? 2 years development. It means what becomes their rental charges? 4 years exploration means that what?
The second extension, the first
No,
extension.
4 years means they'll be in the
first
first
extension.
extension because the first 3 years means they are in the initial.
Yeah.
The next
Yes.
1 year means they found oil in the first extension, the first year. So that means here they will pay what? They will pay $30 times the number of kilometers times 3 years. And then what? $50 times what? The square kilometers times only 1 year. And then
Yeah.
pay the development price. Do you see how it works?
And yeah.
Me always is the mechanics. When you get the mechanics, it doesn't matter how the question is twisted. Some students, you know what they do? They just learn that, okay, if it is initial exploration period, it's 30. So what is the initial exploration period? And most books don't disclose the number of years there. So they bring it, you get confused. Do you get it? But know that initial exploration, 3 years, you have a maximum of 7 years. What if the guy took 6 years to do exploration? And what does it tell you?
Second extension.
It means they'll be in the second extension because they would have done 3 years at $30. They would have done another 2 years at $50 and only 1 year at $75.
So this means you have to calculate for the initial exploration, the first
And
extension.
all of them. Yes.
Okay. Thank you.
Now, when you get to development phase, are you getting it? When you get to development phase, you now pay development there. It doesn't matter. Some people can be in development even for 10 years, 100 years. We don't mind. Do you get it? So development, you pay $100 per square kilometer. And then when you're in production or extraction phase, okay, so pay $100 per what? Square kilometer. Do you want to put this down? I hope it made sense.
So the production and extraction is $100.
Yes. Development and production is $100. So far as you are in development or you are producing, you pay $100 for rent.
Okay.
And it's an allowable deduction. Remember. Please, are you putting it down so we solve this question?
Yes, we have it.
Yes, we've put it down.
Now let's solve this question. Yes, please.
I stepped out a bit. I don't know if maybe you mentioned something that I didn't know, but with the
I will
rental
be sharing
charges,
party jollof when you got up.
then please reserve one for me, I beg.
We are reserving for you.
Next question.
With the rental charges, are we to use the one in the model agreement, or we can use the LI 2359? That's the legislative instrument for 2018.
Please, you just stick to what I've given you on the screen, I beg you, so that there will not be any confusion. I don't want to go into practice. So stick with this one. Are we okay?
Oh, okay. Okay.
Yeah. Prof, please, so with the development and then the production phase, I think I heard that you said development can be there for as long as you want. Does it apply to the production phase too?
Of course, if I'm producing, hey, me cocoa pie na me tete, I will say I have some number of years. Hey, then I okay. I've discovered oil in quantities, and I'm drawing. I'm enjoying my way out. Is there a limit to how much I can enjoy? Remember, Ghana, any oil you find is for
No,
you.
please.
It's for you. So for as long as you are under contract with GIPC, do you understand? GIPC becomes a joint venture operator with you. So
Yes,
muna
please.
boom for double dum. No. Do you understand?
Yes.
Okay, that's it.
And that's all right. So that's it. Okay, so let's try and see. So analyze the question. What do we need? Now note, these rentals are for what? How many years? Is per annum, right? So if it's 3 years, you multiply by 3 after you get it. So let's read. Now, how many area did they give us? The square kilometers they gave us was what? The area occupied was what?
2,200.
2,200 kilometers square.
It was 2,200 kilometers what? Squared. Okay,
Right.
squared. And then they said he did exploration for how much? They said the project was a duration of 5 years. Oh?
Right.
Yeah, 3 years
Yes.
exploration, 2 years for development.
Yes. So 3 years exploration means they were still in the what?
First initial phase.
Surface rentals. That means they were still in the initial exploration phase. So exploration, we'll do 3 years. Or we can find the rental per annum. Then we multiply by 3. Do you get it? That's also not bad. But so exploration, it would have been what? They are still in the initial exploration period, right?
Yes.
So initial exploration, which will be what?
30 times 3.
$30 times 2,200 what? Kilometers squared, right? And that gives us what?
Yes.
Per annum. No, be so. That gives us the per annum. Then we multiply by the number of years.
Okay.
The total. You can decide to go this way. It doesn't matter. I'm just doing it this way, just in case.
Yeah, I wanted to suggest that if we do it in a table form.
Yeah, so this is the table. So multiply. What do we get?
Examination.
1,320,000.
This one is how much? Just this one. Don't multiply by 3. The number of years, I'll now put 3 years here.
It's 6,600.
This one is 6,600.
Hey, sorry, 66,000.
66,000.
Okay, now multiply by 3 years. That gives us
198,000.
198,000, right? Okay. Then we
Right.
count what? The next one. They said what? 2 years for development. So we now came.
Development.
Yeah, that means this guy was lucky. The first 3 years, Nanonya oil. So he didn't go to the next extension period. Do you get it? So that means development, you now pay $100 by the same
Yes.
2,000.
Yes.
No, be so.
If so,
20,000. Oh,
220,000.
yes, but this 220,000, how many years? They were in development for how many years?
2
For
years.
2 years.
2 years, right? Which would have been what?
440,000.
Okay, good. So that means per annum, the annual rental charges will be what? You see, I've killed 2 birds with 1 stone. So now I've been able to get the annual ground rent, which is how much? 286,000. Not so.
286. Yeah.
Total ground rent for all the 5 years would have been what?
638,000.
You get it. So you see how I killed 2 birds with 1 stone.
In tomorrow.
Very easy, right?
Okay, I now understand.
Yes. It is surface rental. Surface rental. Say, let's look at surface. We didn't look at surface rental. Say in here. How much it's me calling?
A minute, please. A minute.
Of crude oil and its co-mininis.
Right. Oh.
So how is oil and gas going?
But what about the production?
No production.
Okay, we're not giving number of years. Okay.
They did. They told you duration of 5 years, 3 years for exploration, 2 years for development. They have not started production yet. That's why the question didn't tell you. So what if the question told you that they had duration of 10 years, 2 years for development?
To be 10 times the area times
You have
100.
look at what I said.
It's
I
not
said
finished.
they said they had what? 10 years, but they said 2 years development. So what does it tell you?
It means 2 years
The
for
next-
development, 8 for production.
No, look at it carefully. 10 years, but only 2 years was for development.
So
The
it means
10
7
years is
years
when?
for exploration
Means
and
they
1 for production.
7 years
Production is
for
1 year.
Exploration, 1 for
7
production.
years for what? Exploration, 2 years for development, the last year
For production.
for production.
Yeah.
So development and production, or you'll be
So
paying
5 years.
$100. You'll still be paying $100, but here it will differ from 30, 50, and then what? 75.
75.
Prof,
Yes, please.
can't we have a situation where even though it's 10 years,
Yes, you
the
can have a different
exploration
situation.
took
Yes,
2
where
years,
exploration could have been
less
maybe
than the
just
7
2,
years? So
3
I want
years.
us to
Yes.
have the exception there so that we don't assume the maximum will be achieved at all time for the exploration.
Oh, I understand. I understand what you are saying. But in my scenario, that's what I was saying.
Okay.
Baby, now.
It could even be 1 year at exploration.
You are right.
All right, please, are we okay? So are we okay with surface rentals? Can we move? Can we move to how to distribute crude oil?
Yes, Prof.
Yes.
Okay, now for Adobe or question be mamiana.
Past question be with some redetermination things, but
don't worry, I'll come
yeah,
there.
also
that
area.
question, no,
I
Prof.
think we
I
should,
wish
we
we
should
can look
follow.
at it briefly.
Where is it? You haven't shared it with me. Who did I share 2 pages? So
Dinah.
Yeah, Shasha, put it on the page.
Prof, are you
I
moving
don't
to
know what
question
page
2?
it is. So you have it. So if you can put it, so I don't know how.
some of the questions you are looking at
Oh, but it was on the platform.
it's now
I'm not on that platform, so I don't know how.
Okay, baby, I'm not on the page, or are we?
Question now,
Just allow him to do what he asked for us.
We are not on the page. So I don't know how to.
Let's do the distribution, then we come to the question you're talking about.
Yeah, I think Prof,
Yes.
we should follow the
Some
order
of us
you
are
are
very, very
driving us.
exhausted.
Yeah.
We are not yet on leave. Let's do the distribution, then we come to the question.
Okay.
It's true. Some of us went to work today.
Yes.
Your mommy calls.
As I'm speaking, I'm still at work.
Your mama.
Prof, should I read question 2?
Read question 4 first. Let's do question 4.
All right. Question 4. ABC Limited has 40% and 30% interest in Coastal Reef Petroleum Agreement and Deep Sea Petroleum Agreement, respectively. The contract areas of the 2 petroleum agreements have been unitized for joint operation. It has been determined that the hydrocarbon present in the unitized area is in the proportion of 40% and 60% for Coastal Reef contract area and Deep Sea contract area, respectively. The gross production of crude oil in the unitized area in 2018 year is 500 million barrels. The average price of crude oil that year is $50 per barrel. You are required to compute the gross income of ABC Limited for 2018 year of assessment.
Chairman, wait, the uncle also reading news of BBC. I like the reading and the calmness. Thank you.
Easy, Atobra.
Yes, done very well. Now, unitization in itself is a frequently occurring topic, right? So there's a common question that they mostly like to ask you, right? That explain the following concepts, highlight the types, if any, and its importance. Okay, so please read for us, read the question, read the solution. We don't have time so that we can do a lot, because after the distribution and the computation of the income, I'll do thing capitalization and possibly the other anti-avoidance way, then we close. Then I know that at least 50 there. Please read and let's go.
So I should start from question 1, the theory aspect.
Yeah, theory.
Okay. So question 1, explain the following concept, highlighting the types, if any, and its importance. The first one is unitization. Unitization refers to the joint development of a hydrocarbon reservoir, which extends across 2 or more licenses or contract area in order to ensure efficient production of the reservoir and to maximize the economic recovery of the petroleum from such license. Where during the appraisal of a discovery, it is found out that a hydrocarbon reservoir straddles 2 licenses. It is common in the industry that the licensees would agree to pool their resources to jointly exploit the reservoir. This avoids the duplication of infrastructure and well drillings to produce the same reservoir. Cost is thus reduced. In some cases, the hydrocarbon reservoir cuts across the borders of 2 countries, where licensees of each country agree to jointly exploit that reservoir. It is referred to as cross-border unitization. The term sole country unitization is used to describe unitization which solely takes place in one country. That is where hydrocarbon reserve straddle 2 licensees in the same country. The second concept is redetermination.
Before you go to redetermination, you all understand what unitization means, right? So let's say we have 2 contract areas, right? I've given license to maybe Cosmos, right? And I've given license to what? Talu. You get it? And they are all doing their what? Oil, petroleum operations. But where they ended up hitting oil, are you getting it? They straddle across. Like, this one has its border, but it's the same reserve or reservoir here. Do you get it? So because all of us are hitting the same reservoir, what we do is that we enter into a contract, a unit operating agreement. Do you get it? So that both of us will what? Come together and what? Exploit this reserve, right? After that, we share according to our resources. Does that make sense? Does that make sense? Because
yes.
if the same reservoir we are drilling and I have to use resources, you have to use resources, it doesn't make sense. So why not come together, pool resources together, save costs, do it together. After that, we share according to who contributed what. This thing has transfer pricing implications, but it's beyond the scope of your syllabus. Because usually in international arena, what we do is that we end up doing the cost contribution arrangement computation to determine the appropriate transfer pricing method to be used, which is mostly cost plus or transactional net margin method using a net markup. All right. Then technology transfer tools come in. Then when we bring in the materials, we also look at transfer pricing in terms of customs valuation and industry analysis. So mostly this one that you see like this, right? You see this one is in the same country. So we call it sole country unitization, where it straddles across the same country, but 2 different license areas have been merged together as one because they all hit the same reserve. But what if here was Cote d'Ivoire? Do you get it? Cote d'Ivoire, and here was Ghana. We share a border, but the same resource. The border is just something man-made, but the resource, God created it. So maybe a part of it is in Cote d'Ivoire, a part of it is in Ghana. So what happens? The 2 companies, the one in Cote d'Ivoire and the one in Ghana, will come together. Are you getting it? So that they can operate it under a unit operating agreement. So we call that cross-border unitization. So what 2 types of unitization did I give you?
Cross-border and same
So
country.
Country unitization.
And then cross border.
And then cross-border. Cross-border means it crosses border, right? 2 different countries. I get it. Good. So they come together. So mostly when they come together, right, they will jointly exploit the reservoir, but they choose what we call a joint operator. What did I say? They choose what we call what? A joint operator. So that joint operator is under the unit operating agreement. So he's the one who is going to manage all their affairs. So the examiner can see that he said, unitization and redetermination has come so much. So now I'm going to ask the student for the functions or the roles and functions of the joint operator. Do you get it? So you are expecting unitization and redetermination to come. Then they ask you the functions and the role of the joint operator under a unitization agreement. Write it down. Go and look for what the joint operator does. I can't teach you now. I'm tired. All right. So we have understood unitization, right? We have understood the types. Good. You now know what unitization means, right?
Yes.
True or false?
True.
Yes, please.
So there's a scenario. There's a scenario. Anytime you forget unitization, remember, there's a scenario where in the labor world, one man's side chick is giving birth and the real wife too is giving birth. Right? The man will visit this one and go here and go and visit. But it was waste. So finally he disclosed the truth and two of them held hands and they decided to pay the man back. So that is unitization.
Hey, sorry.
So this one, is this so country or is cross?
Cross-border unitization.
What about them going to different hospital and decided to send them to one hospital so that he can visit and use the same transportation?
If they are all Ghanaians, so country. If one is Ivorian, cross-border.
Cross-border. Thank you. So this is how you remember. That's how we learn. You relate it to something you can remember. So your brain remembers in that fashion. That's all. All right. So we have seen unitization. We have seen the types, right? And that alone is going to give you 8 marks. Now, the 4 marks left is redetermination. Now, when we talk about redetermination, what does it mean? Now, this is a process where the proportionate share of the oil and gas initially determined to be in place. You see, when this guy had his contract and this guy had his contract, they may have still been in the exploration phase, right? But then maybe into Makatadia, so do you understand? We don't know what was really there. So our initial data that we had, we came up with some percentages we are going to share. But after digging deep, after we utilize, are you getting it? We utilize the reserve very well. We realize that there's more to it. Do you get the idea? So we now redetermine our percentages. So that is where our proportionate share initially determined to be in place in the contractual area for each license during the unitization is now reassessed because now more data has been obtained about the field. Do you get it? Look at it. You and your brother, right? Your mother said there's some jollof in the fridge. Okay. So he said, oh, your mother said the jollof there is left with small one. So he decided and he told your brother that if you go home, I'll give you only 20%. I'll take 80% because I'm the big brother. But when the jollof was plenty, are you still going to share the same percentage again?
No.
Are you going to share the same percentage again? No. Because it will not be fair, right? Because it's too many. So because of that, you say, okay, now let's share 60-40 because it's in abundance. That's redetermination. Makes sense. Before, you didn't have so much information, so you use some particular percentages. But now, you have so much information. Maybe this time it was smaller. So the one who contributed more should get more, but maybe not the same percentages. So you reassess what was originally what was originally agreed. Do you get it? So as more data is obtained about the unitized field, it is common for the information derived to be used to redetermine the oil and gas in place in each contract area of the unitized field. This is an important principle because it allows for a more accurate allocation of cost and production between the parties to the unitized agreement. So in international tax, an appropriate transfer pricing method will be agreed for the transfer and the allocation, which becomes a cost contribution arrangement. There are 2 types, a service CCA and a development CCA. This is more of a development CCA. And then the most appropriate transfer pricing for services and the manufacturing will mostly be the cost plus or TNMM using a net markup. Okay, good. So, unitization redetermination gone. Is it gone? It's gone. So I want somebody to explain unitization and explain redetermination quickly. Then let's solve this question and let's do the distribution of crude oil.
Okay, so Prof, please, with the unitization, two contractors can come together. That's they want to develop what a joint area, because maybe there are hydrocarbons that extend across their original block. So here they'll put their resources together to develop the area, and it helps with cost efficiency and also improve the operation so that they're able to get a maximum volume of production from there. And then with the redetermination, like you said, initially, they had assumed that there would be maybe this quantity of hydrocarbons, and so they have a percentage share in it. But later, there's availability of new information to them. And based on that, they reassess the hydrocarbons in the area, and it leads to some new rates different from what they initially probably agreed on.
Not bad, not bad. Thank you. I like that. It means you were listening. Good. All right. So now that we understand unitization and redetermination, can you imagine CITN? Sometimes they play people wicked. They brought this question, and they said compute the gross income of ABC Limited for 2018 year of assessment. Do you know what happened? Some people started computing royalties, and then they started doing initial interest and additional participating interest. It wasn't necessary, because here, who were the partners? Why are you doing all that? It wasn't really necessary. Do you understand? So read and let's go. Read and let's go. We have a lot to do.
ABC, last question 2.
Yeah.
ABC Limited has 40% and 30% interest in Coastal Ref Production Agreement and Deep Sea Petroleum Agreement, respectively. The contract areas of the two petroleum agreements have been unitized for joint operation. It has been determined that the hydrocarbon present in unitized areas is in the proportion of 40% and 60% for the Coastal Ref contract area and Deep Sea contract area, respectively. Gross production of crude oil in the unitized area in 2018 is 500 million barrels. The average price of crude oil in that area is $50 per barrel. You are required to compute the gross income of ABC Limited for 2018 year of assessment.
Okay. So the whole thing is that there were two separate companies. Who were the two separate companies operating? Coastal Reef has its contract. Deep Sea had its contract, right? But they came together, okay, to produce in what? The proportion of what? 40-60. No be so. No be so. So under the unitized agreement or the unitization agreement or the unit operating agreement, there are two companies. Who are they? Coastal Reef, right?
Yeah.
Coastal Reef owns how much?
40%.
40%. And Deep Sea owns 30%.
No. Look at it carefully. This one is an investor. This is
A
an
40
investor.
and 60, sorry, 40
An
and
investor
60.
invested 40 in Coastal Reef.
Yes.
So whatever
Yes.
Coastal Reef will get, you will get 40% of it. And other investors will get the rest. And then Deep Sea, that investor also gets what? 30% of Deep Sea. Do you understand?
So, sir, the investor is the ABC Limited.
It's the ABC. Thank you.
Yes.
Makes sense. So Coastal Reef in the unitized area, Coastal Reef had what? 40%. And Deep Sea had
Yes.
what? 60%.
60%, yeah.
So in that case, how much petroleum was produced there? So what's the total petroleum that was produced? The total barrels. Gross
500
production.
million.
That's 500
So
barrels.
our gross production,
500 million barrels.
yeah. So our gross production in barrels at that what do we call it? At that level was what?
500 million barrel.
500 million
million.
barrels. But how much will Coastal Reef get out of it? Because they are unitized. So this was 500 million barrels. So where will get how much? Coastal Reef.
200 million.
40%
Coastal
of
Reef will get
40%
40%.
of 500.
Are you seeing how unitization is interesting?
Yeah.
Good. Then Deep Sea will get how much?
60%. So
60%.
that's 300 barrels.
Okay. So the guy at the top will get what? 200.
200. Yeah.
And this guy will get what?
300
300.
I get it.
Good. Now, this that they have made, there's an investor who has also invested in these companies. Mewa.
Yes.
Right.
So we need ABC's what? Share.
Share.
So let me get his share in barrels. Then let me get
ABC.
the price.
80.
Then let me get the total, right? Good. So in that
So-
case, ABC, his share in Coastal Reef. He invested what percentage in Coastal Reef?
40%.
40%.
He owned 40%. So he'll get 40% of the 200,000. No be so.
40%.
Yeah.
Yeah.
200 million. Let's work in thousands. We don't have time. So 200,000. And that gives us what?
80,000.
80,000.
80,000, right? In thousands.
Yeah.
But then the price per barrel was 50.
50.
50.
And for Deep Sea too,
million.
he owned what?
30%.
30%. But Deep Sea made 300, right?
Yeah.
Right.
So you get what? 90,000. So this
Mm.
90,000 to the barrel per price, 50.
50.
So the total barrels he received was 170. Oh,
Yeah.
Yeah.
but then the total revenue he received was what?
8.5.
So this one will be what? 85?
4 million, 4.5.
1 million.
4.5.
1 million
4.5.
and 4.5 million. Okay. So that means we have what? 8.5 billion, right?
Yes.
Good. So ABC Limited received what? Receives a gross income of what?
8.5 billion.
Or receives what?
8.5 million.
170 million barrels, huh?
Barrels.
170 million barrels, contributing a gross what?
Income of
Gross income of 8.5 billion Ghana cedis. 10 marks. I deal with 10 marks. Then yeah.
Prof,
Yes, please.
are we not supposed to account for any royalty?
That is where your confusion comes. And I told you that this question came, all the students deviated because they went to calculate royalty and additional participating interest. No, sir. They didn't ask you that it's in contract with anybody. I beg you. They just asked you for the gross income. So just share the gross income. That's all. If it was a full petroleum question, you would know. Do you get the difference? Is it clear?
Yeah, clear.
Okay. Unitization rate determination going? Gone. It's gone. All right. So in that case, let's now come and understand how to deal with computation of crude oil questions, right? Now, this question, they can twist it anyhow they want, but just get the whole idea. Once you grab the whole idea of these kind of questions, then I'm happy for you, right? So this kind of questions follow phases. There are so many phases of it. The first phase is one. I prefer we determine the capital allowance, right? First. So after determining the capital allowance, the next thing you do is to distribute the crude oil, right? Is to distribute the crude oil. After distribution of crude oil, the third thing is to compute what? The petroleum income tax, right? So petroleum income tax and other taxes. You see the way for mining, we also do it. If there are any royalties, you go and calculate. If there's dividend withholding tax, you calculate. If there are dividend withholding tax, you calculate. You remember? Same thing applies here. Then you have what? Your government take, okay? So government take is how much government receives, right? So you can have your government take as income and even government take. So you can have government take in absolute terms or government take as a percentage, and you can have government mean take. That's the average government take. Do you get it? So when this question comes, this is the old type of questions you'll be getting, but still they can bring it, just that they'll twist the variables here. And these variables, we've spoken about some of them when we're talking about petroleum income and expenses. Do you remember? Now, and I say, you I did it. I said, bro. So we should close.
Prof, let's finish this one.
Let's finish this one and close, eh? Yeah, I can't.
Prof, the mean take and then the difference.
You said the mean take and the government take, the difference. You said the mean take and the government take, the difference.
I thought it's the same. Or
this one is called darling. What's your problem?
No, it's not the same.
So what's the difference? The people who said it's not the same, what's the difference? Tell me.
So the government take is the oil that the government will get in terms of the carried interest and then the additional participating interest. But the government mean take will include other things like royalties and others.
Hey, are you sure?
Which go?
The government
The confidence alone.
is the royalty. The government take is the royalty, carried interest, additional carried interest, and then the income tax from the partners. And then the government mean take, you express the government revenue over the total, let's say, volumes or barrels. If it is valued, the value of the production, yeah.
A percentage expression of.
No, come again. You say you express it over the total what?
The total value of production.
The total value of production.
Yes, so assuming you have the volume, if you have the volume of production as in the output, and probably you are giving an average selling price, then you that will give you the value.
Okay.
So it's a proportion of what the government derive from the petroleum arrangement in terms of the fiscal policy, like the tax, the royalty, carried interest, additional carried interest, being expressed as a percentage of the total output from the production.
Okay, if they tell you that the government take as a percentage and determine government mean take in one question, you are telling me they are the same.
One is absolute and one is percentage.
Okay, let's take it like that. I don't want to. You have fun saying I'm wondering now.
So trying the right one, why?
I can't make you go and get 100. So.
Hey, from 900, I don't say better what a bro school.
Don't worry. I've already gotten more than 50 awards. I've already gotten more than 50 awards.
And I mean, pushing us.
Award into the every you.
Don't worry, I will teach you. That's exactly what they have said. Don't mind me. Eh? So I'll teach you a shortcut, right? To get the mean take, it usually wastes time. Because do you know that you are expressing everything as a percentage of the total income received from the actual agreement? Do you get it? Including government share, the contractor share, and everything. Do you get it? But this is the process. So before, they used to tell you, like these old questions, they said capital allowance, distribution of crude oil, the income tax, this. Now they don't ask you. They'll just go straight and say, determine what? The government take. So if they tell you to determine the government take, and you don't do all this, you can't get the government take. Do you get the idea? So they'll just start the question and say, determine the government take 20 marks. And you know that now they didn't tell you to determine capital allowance, distribute crude oil, get petroleum income tax, government take, or government mean take. Do you get the idea?
Yeah.
Do you get the idea? So follow this. Have you written the steps down? Can we go?
Yeah.
So let me show you how to
Yes,
distribute
sir.
crude oil. So when it comes to the distribution of capital allowance, you know already, but I'm going to teach you. When it comes to distribution of crude oil, okay? Remember, GMPC is a joint venture what partner in all petroleum operations. So when you take your gross what production in barrels, all right? When you take your gross production in barrels, you are now going to less what royalties. Are we okay? Which is mostly 5%, right? Of the gross production. Now, note, if there's sole risk, if there's sole risk operation, and they said maybe the person who took the sole risk needs 5% for compensation, a percentage of gross production, they will tell you. If it's a silent, you can just take it as a percentage of gross production, just like the royalty, and compensate the person because he took the risk. Okay? So sole risk can come in the form of two types. They can give you two in one. One is the compensation of the cost, which would have been taken from here directly, either in cash or in premium. The premium too can be taken after, so they can agree with the person that, okay, we want to give you sole risk premium as a percentage of the distributions, and we will give you the compensation of the cost from the raw gross production. Do you understand? But if the question is silent, just come and take it like the way you treat royalty. Makes sense? Makes sense. But most questions don't have sole risk operation. So
Makes sense. I didn't get the first one.
which first one? Which first one?
You gave two
I'm
scenarios
saying that
where
sometimes we share the sole
where they'll
risk
give
here.
you some information.
I'm saying that sometimes we can share the sole risk here, like the royalty, or we can share the sole risk after the net production. That's what I mean. So that means that the net production, GMPC, instead of having just initial interest and then whoever is the way, he'll first get his sole risk. Do you get it? Which maybe was 5%. So he'll get 5% off the net production.
Yes, please.
You understand? Before you come and get his initial interest. Do you get the idea? Do you get the idea?
Okay. Yes, please.
So it depends on the nature of the question. Is the question which
yes,
how?
please.
Life is silent. This is the treatment. Yeah. I mean, your hand is up.
Hello, sir. Please, how, in case a question comes with growth and sustainability levy, how do we treat it in such a case?
Growth and sustainability levy is not included in a separate way. So once you get a profit, okay, once you get a profit before tax from the way, you are just going to take the 5% of it, then you divide by 4. Then each quarter you will be paying it as tax. It's a separate tax, but it still goes to government. Do you understand? It has nothing to do with the computation in itself.
The reason I'm asking is because I saw somewhere that for petroleum industries and mining, their GSL was, I think, 1% of their gross production. That's why I'm asking if how do we treat that one?
Okay, so it's a levy. So it has nothing to do with the allocation in itself.
Okay. So you calculate that one separately and
Yes, it's actually a tax. So it's calculated separately.
Okay.
Sir, I have a question. The growth and sustainability levy, the upstream is 1%, right? And the downstream is what is the percentage?
Unless I go and look at the
It depends. So the financial institutions use the 5% of their profit before tax, and
yes, there are
then
various
any
and yes.
and then any other company that does not fall under category A and B is 2.5%. So it has like they've grouped them into categories. So the category A includes the financial institution, this insurance, then the B is the upstream petroleum and mining, And then the C is the any other that does not fall under A and B. So that one, I think, unless you read on the those that constitute the category A before you know the amount to charge for the company you are dealing with.
Okay.
So the initial interest or the carried interest, right? GMPC can get up to what? What's the maximum you can get for initial interest or carried interest? Hey, you don't know.
15%. 15%.
Question give us.
What if the question doesn't give you and say went with the maximum? So it depends, right? So this is why we are sharing the net production because GMPC is a partner. So a GMPC is literally partner A. It doesn't mean you have to share it this way, but you get it. Then the additional interest. So the additional interest, which maybe if it's 5%, 5% of this, are you getting it? So you are sharing this. So this is the one for GMPC, right? Then you share for the other partners. So let's say JV partner, what? Partner B, are you getting it? Let's say he contributed what? 30%. So we'll take 30% of what? The net production. Do you get it? Then maybe JV partner what? Partner C contributed maybe 50%, right? Of the this thing. So he does it. So at the end of the day, when you sum this allocation up, it should equal the total net production that you had, right? Which means you have finished allocating it. Does that make sense? Does that make sense?
Yes, please.
Yes.
But look at something here. What if the percentages are more than 100? Because it's possible. Let's explain. Look at this scenario, okay? So initial interest, okay, of GMPC in this one was 10%, okay? Let's see. Additional interest was 5%, okay? Coastal Reef, okay, who is one of the partners, contributed 50%, okay? Then Deep Sea also contributed 50%. Can you see that? So you see, this will make the percentage go beyond 100. True or false? So let's say that the gross production is now what? Say gross production is 100,000. Let's take royalties as what? Royalties at 5%. Okay. Then cost of crude oil is
I think it's 40 or so.
Oh, 5-4.
Philip.
Can you hear me? The network. Can you hear me?
Yes, please.
Yeah.
Okay. So this is the information we have been given.
Prof.
This is the information we have been given, right? So this is the information. So this a petroleum agreement. Okay, very simple, but it's a full question though. So that takes us through everything. So let me just add something. Okay, so let's say there was bonus.
Cost oil.
Bonus of 200,000, and then there was what? Interest on loan for construction of oil rig. Okay, construction of oil rig. That was also 150,000. Okay, then there was machine bought, right? Machine acquired, 25,000. Then there was geological cost. Then there was geological cost of 125,000. Okay, geological cost of 125,000. Okay, so this is what we have. So the requirement is to what? Calculate the total government take as in Ghana City and the mean take. Are we okay? Did you see the question? It's very simple, right? So two partners, coastal reef, deep sea, and then what? Government. So we have seen everything there is and in the agreement. So we are going to use this. Once you understand this, it means that you can do any question. So what I am concerned about now is the distribution of the crude oil. So you already know the approach, right? How many barrels were produced?
100,000.
That's, yes, 100,000 barrels. So we are going to now apportion according to, but because this is what? More than 100. Because when we add everything up, initial interest 10, 5, 50, and 50, it will be a total of 100 and what? 15. So that means you are sharing. Yes, you can do what? 10 out of 115, 5 out of 115, 50 out of 115, and 50 out of 115. Do you get the idea?
Yeah.
Good. Or you can make it, you can convert it into decimal and use it, which will make it faster if you want. It doesn't really matter. So let's go and distribute the crude oil. You see the first one, mostly they'll make it equal to 100, but let's go and distribute the crude oil. So distribution of crude oil. So in that case, let's distribute the crude oil. What's the gross production in this case?
100,000.
100,000.
Okay, so we take this 100,000, right? Then we less what? Royalties, not so? A royalty will take what? Take 5% off the 100,000. That gives us what? 5,000. Oh, we take it out. We come and get the net after royalty, right? So the net after royalty will give us what? 95,000 also. So this will be distributed as follows. Okay, this will be distributed as what? As follows. So in that case, we first go to GMPC, right? So GMPC came in the form of what? So the percentages were more than, yes. So the initial interest per our agreement, they say initial interest was what? It was 10%. So 10 out of 115. You see, this time it's not 10% because the total was more than 100. So we can 10 out of 115 times the 95,000. Can you see that? Do you all agree?
Yes,
And this
sir.
one too, we said 5. So 5 out of 115 times the 95,000. Somebody said say. Are we okay?
Yes, sir.
Okay. So what do we get? Then we come to coastal. Coastal reef contributed what? So it becomes 50 out of 115, right? Times the 95. Then deep sea. Deep sea also contributed 50, right? So 50 out of 115 times what? The same 95. So what do we get then? Give me the figures. Quickly. We have a lot to do. See the normal one, the percentages always add up to 100, but with this one, it's more than 100. So that's why you add everything together and apportion that way. So what do we get? The more you are slowing down, the more I'm getting tired.
8261.
This one.
8261.
Then the next one.
4131.
4131. Then the next one.
41310.
41310.
The same for the other one.
Yeah, so if you add all back, you should get back the same 95,000 also. Then you have allocated it. Now, look at how it gets interesting. You see that because the whole gross production that you did, are you getting it? Summed up to what? 100,000. That means the total revenue that would have come. The initial interest government would have got, just multiply by the 50. The additional interest, just so straight from this table, you just get it straightforward and leave it there. Do you get what I'm saying? Yes, and yes, sir, when you finish, you have to recalculate this again. Where's another work?
No, please come again, Prof.
I'm saying that if you finish everything, assuming you only distributed this crude oil, you have to come and multiply by 50, by 50, by 50 again, which is another work. So why not just do it straight in the distribution table? So that I get a total revenue, the revenue for royalty and the rest. So that when you finish the taxes of the partners, you just come and add everything. And then you divide by the total to get your mean take. Do you understand? That's why I'm just multiplying by the 50. So that I get the revenue, the total income already.
Yes,
So that I don't have to come and stress to redo it again. That's what I mean. So this one should have been how much? Is it 250,000?
41.
This will be 250. Then this one, the initial interest will be what?
Yes, 250.
The initial interest will be what? Just multiply by 50.
$413,050.
413,050. Then this one.
206550.
206550. Okay, so we are done with the distribution. The rest we'll use it in their tax computation. So now the next thing is to compute capital allowance, right? So we say capital allowance what? Computation. So to compute capital allowance, you must first start with what? The single pool, right? In accordance with what? Section what? 65. But if you don't remember, you say in accordance with relevant sections of what? The Income Tax Act, all costs, I get all pre-production costs. No be so? Are to be what?
It be so.
Are to be placed in what? In a single what? Pool until what? Until production what?
Production
Commences.
Then capital allowance will be granted at what? 20%
20%
straight line.
straight
No be so?
line.
Good. So in that
5
case, let's get the
years.
single pool. So when we get our single pool itself, we'll break it into exploration and development. So let's start with exploration cost. Yeah, Mr. Brian, your hand is up. Let's start with exploration cost. Did we have exploration?
Sorry for taking you back. Just to confirm, coastal, the rate of coastal was 50%, and that of deep sea was also 50.
Yes.
Okay, I was thinking was
no. This is not the question. No, this one is my own question that I came up with to help you understand the process. So it's 50-50. Yes. Not this one.
Okay. Okay. Thank you, Prof.
So let's see. Where were we? So listen carefully. I'm giving you. So if you have exploration costs, you see some 2018, all of them, you sum them up. Do you get the whole idea? You sum them up. So look, you see here, they've given you total development cost, meaning that whatever year they started, this is the total development. So the same way, if you see development costs from all years, add all. Exploration, add all. But there's another thing I want you to get, not even this one. If you see bonuses, is to acquire a license. You get a license before you explore, Meboa. So all bonuses should be added to exploration cost. Signature bonus, add it to the exploration cost. If you have geological, geophysical, seismic cost, add all to exploration. Do you get the idea?
Yes, sir.
But if you have things like machines, assets, interest on loan, that means it's borrowing cost, IAS 23, right? So interest on loan for construction is always added to the cost of the asset. So add it to development cost. Do you get a trick? If there's production bonus, create a separate pool for it and grant capital allowance on it separately. So you share for the partners because it belongs. GMPC will get its full percentage share. Do you get the idea? But don't worry about that. So, did you get the whole idea? I said geological, geophysical cost. What do we add it to? Exploration. Machines applied, interest on loan. What would it be added to?
Development.
So anything concerning other assets acquired has to do with what? Development. But what if they say drilling of exploratory wells? Where will it go? Exploration.
Exploration.
Do you get the whole idea?
Prof, and the bonus payments will add it to which one, please?
Exploration. It's a lump sum to acquire a license.
Exploration,
you get the license
right?
before you explore.
Okay.
Yes, so you add all to exploration. So can we determine the total exploration cost?
Okay.
Yes, we can. So exploration, the total exploration was what? 500,000. Then we add the bonus, right? Then we add the bonus. Then we add the what? Geological cost. Oh. So please, have you captured it? Yes, can we go?
Yes.
Okay, so now since I don't want us to be scrolling up and down, so exploration is saying
825,000.
okay, so the exploration cost given how much?
500,000.
500,000.
Yeah.
Okay, then what else? The bonus, right?
Bonus
The bonus was how much?
200,000.
300,000. 200. Okay.
200.
Then what else will we add? The geological cost, right?
Geological. Yes.
Yeah, geological cost. We add it. So some years they'll give you
125.
plenty exploration costs. Add all of them. So if they gave you exploration for 2017, add it. All exploration costs at every year you add. Geological was how much?
125,000.
125.
Say what they are mentioning, I'm not getting it from the
No,
question.
you see, it
Yes,
means you are
it's at
not
the
following
top.
me. I said the question is from my head. It's not this one. I'm teaching you how to go
Okay.
about it. So I
That's
gave
okay.
you the
Thank you.
data from here. Are you
That's
following?
That's okay.
You get
Thank
it now. Good.
Thank
Okay. So these are the data. So capture it so that you have it with you. Okay. So this is the information we are going to use. So was that all the exploration cost? Yes.
Yes.
So what's my total exploration cost now? That's
825,000.
825,000, right? Good.
Yeah.
So that's my total what? Exploration cost.
Exploration cost.
Okay. So I'll say since government does not what? Government does not contribute towards what? Exploration. Does government contribute towards exploration?
No.
No. Since government does not contribute towards exploration, right? The exploration cost shall be allocated as follows, right? Exploration
Yes.
costs shall be allocated as what? As follows. That means it will only be shared with who? It will only be shared with what?
Coastal.
Coastal, shared between Coastal
The
Reef
partners.
and then what?
Yes.
And then deep sea only. Not so.
Yes.
So that means in this case, the percentage is going to be what? The 50 plus the 50, which gives us 100, right? Government is not involved.
100.
Yes. So in that case, the total was 825. So if we want Coastal Reef, what becomes the exploration cost? That's 50 out of the 100 times what? Times the 825,000. No be so?
825.
Then deep sea.
It be so.
That's 50 out of what? 100 times the same what? 825, right? Good. So what do we get then?
412,500.
412,500. Okay, so this one gives us 412,500. 412,500. Okay, good. So next one is what? Development cost. No be so? So the same way we say development what? Cost. So let's get the total development cost. So development cost, let's go up. I thought you had the
1
figures, but
million.
let's go.
1 million.
So development cost, the total development was 1 million. Then we had
1
interest
million.
on loan for the rig, right?
Yes.
Interest on loan, borrowing cost. Then we have machine acquired, 25. Development cost. So we have the development cost given. How much? 1 million, right?
1 million. Yes.
Then we had
Yes.
what? Loan
Interest on
interest.
loan.
So we had the loan interest,
150,000.
150,000. Then we have what?
Then machines.
Yeah, machines.
25,000.
Machines acquired, 25,000. Okay, good. So this was all for the development, right?
Yes.
So
Total is
development cost.
1,175,000.
So 1,175,000.
1,175,000.
Okay, 175,000.
5,000.
Okay, good.
Yes.
So now, since government contributes towards what? Contributes towards development in the form of what?
Additional participating interest.
Yes, so in the form of additional participating interest. Participating interest. The development cost shall be apportioned as follows, right? Are you all following? So the development cost,
yes, please,
shall be apportioned
Hello, Prof.
MTN phone network MSC Apple. Maybe on person me pon. Okay, so now how much was the total? Can you hear me?
yes,
Development
please.
cost will be how much? Development cost will be what? That's 50 out of 105 times what? The 1,175,000. No be so. And then Deep Sea will get what? The same 50 out of 105 times the 1,175,000, right? And that gives us what? We don't really need a government share though. Do you understand? So what do we get?
I did.
559524. Right? 559524. 559524. Right? Okay, so we have gotten this. So now we can get the capital allowance computation, right? So let's get a single pool. So we have what? Coastal Reef, right? So Coastal Reef is here. Then what? Deep Sea is also here. So Deep Sea Petroleum Operations. Okay, so in that case, let's bring all the exploration costs here. So exploration, Coastal Reef had what? They'll have the same capital allowance because the exploration and development was 50-50, same. 412,500 plus 559,524, right? 412,500. Then development was what? Development was what? 559,524. True or false? True or false?
Development.
I mean, do you understand what I'm doing?
Yeah.
Yes, Prof.
Yes.
So after that, you allocate to both of them. So how much did we get? It's correct. That's 972,024. 972,024, right? So 972,024. 972,024. Okay. So now this becomes like the capital allowance expenditure for each of them. Then we get a capital allowance over 5 years, right? I usually prefer that 5 years or use 20%. It's still the same. It's still the same for both of them. So what's the capital allowance for Coastal Reef and Deep Sea?
194,405.
194,405.
Yeah.
So 194,405. The same for both, right?
Right.
Good. Okay. So now that we have this one, we now need the tax liability, right? So let's take them one by one. So we have what? Coastal Reef.
Coastal Reef.
Then we say what? Computation of tax liability, right? So computation of chargeable income and tax liability. And tax liability for the 20XX year of assessment. Basis period, that's from 1st January 20XX to 31st December 20XX, right? This thing will always be marked. So in that case, we have our revenue, right? So to get our revenue, you see here how we are computing the profit. We didn't take what? Did we take profit and work back, or we are starting for revenue?
Yeah, starting from revenue.
So there are two ways we always compute income. If you don't see any profit, don't worry yourself. Start with the revenue and less allowable deduction. Do you understand? Good. So the revenue, you go and take how much. Remember, revenue is quantity times price. How much was distributed in the distribution? It was Coastal Reef 41310. Oh, no, be so. Was it not 41,310? Yes. So in that case, the revenue will take the 41,310.
Yes, that is it.
And multiply by what? The $60 per barrel. Not so? Then we less allowable deductions.
Yeah.
So how much do we get for that?
2,478,600.
2,478,600, right? Okay.
Right.
Then we less allowable deduction. So allowable deduction, we have cost of what? Production, right? So what's our cost of production? We said it's the same 41,310, right? But now we are producing at $30 per barrel. No be so? 41,310 by $30 per barrel. That's 1,000,000.
1,239,300.
Okay, 1,239,000. You see, this thing is a full question.
Yeah.
And it's making sense, right? 239,300. Okay. Then we add what? Capital allowance, which is also what? Another cost. Mewa. So capital allowance, we add what?
Like
194,405. Yeah, so it's also an allowable deduction. 194,405, right? So this becomes the total allowable expenses. So in that case, this plus 194,405.
1,433,705.
1,433,705, right? So we less, and that now becomes our chargeable what? Income. Not so?
Right.
Good. So what do we get for the chargeable?
1,104,485.
4,044,895. So we tax at what? 35%. Oh,
yes.
and this one will be the same for all of them, or there's a difference?
No.
They all had the same revenue because it's 50-50, so it's the same. So once you do for one, it's the same for the other one, but you have to still redo it too because there's marks allocated. Do you understand? So 1,044,895, but because of time, I won't do the other one because it's still the same figure. Do you all agree? So we'll repeat it twice. So that means we'll end up getting what? 365,714, right? 713.25. Okay. So this is, yes.
Prof, can't you write assumption and say that since the determinants are the same, the same amount applies to? Are they interested
No.
in
You have to
any
recalculate.
time to write all the principle? We know.
You
Is
have
it
to
the principle
rewrite.
or the effort?
No. You have to rewrite.
Okay.
That's actually fine. Yeah. So now we can get the total government take, right? So let's go and pick. So now we already know. So let's get our total government take, right? So total government take. So our total government take, what revenue did government receive from this arrangement? One, he received royalties. Mokai.
Yes, Prof.
Didn't government receive royalties? So let's go to where we had
Yes,
the royalties.
royalty.
You see, now we would have come to multiply the royalties again by the the revenue. But since you have already done it, that's what I was saying. Just go and pick them from the distribution. Straightforward, you
Okay.
see. So just come and pick what? The 250,000,
Okay.
the initial interest of 413,050 and 206,550. Copy the figures down and let's go, including the total income. Are we there?
Yeah.
Okay, so now we already know the total income of the contractors too. No be so? Okay, 247,600. Okay, so royalty. Government you're saying? Royalty.
250.
250,000. Okay. Then government also got what? Initial interest, right?
Initial carried interest is
How much?
41.
See, I said write it down. You said okay. Hey.
413.
413.
413 what?
413. 050.
050. Okay. Then additional interest.
One of the most dangerous.
206,550.
206,550. Okay.
Yeah.
Was that all?
Yeah,
Government also
that's all.
received what?
Corporate income tax.
Yeah. So petroleum income tax. So petroleum income tax. We had what? We had coastal, right? So coastal reef, government received how much? 365,713, right?
365,713.
713. And then for deep sea?
I think it was 715, sorry.
713. So 731,427. 427, right? So in that case, that gives us what? Total government take. Mewa.
Yes.
Okay. which is how much?
1,376 and 26.
1,376 and what?
26.
And 26. Okay. But then what was the total income?
The total income.
It was 5 million. Oh, from the entire agreement, which 5 million should have come out. But out of the 5 million, government DA is saying 1376. So as a percentage, government received a total of 1376026 out of the total 5 million. Do you get it?
So please take it again, please.
No, the total income was 5 million. The production barrels, I did it in the schedule. Share. Gross production 100,000. Each revenue is $50.
Yeah.
No, the revenue was not 50. It was 60. We went to use 50. But you understand, right? It's just understand.
Yes, please.
So this one, you take it and multiply by the revenue. That gives you the total income that should accrue to the agreement. In out of the total income of 5 million, no, government there is saying government in 1,376. Do you get the idea? That's what we mean by the mean take. The average take of government from the total. The government, what percentage?
27.5.
So that means the other contractors enjoy the other part. Do you get it? In the government, in 27.5. I try to say the rest of the percentage too is the mean take of the other contractors. Makes sense, right? So they can even ask you the royalty mean take. If it's royalty mean take, how do we get it? Royalty mean take will be the percentage of royalty over the total income.
Yes.
Initial interest mean take, it will be this one over the what? The total income. What about the mean take of Coastal Reef? It will be the revenue of Coastal Reef over the total 5 million. Do you get it? They can decide to change the style. It's not always government mean take. They can ask any mean take. What about additional interest mean take? It'll be 206 what? 550 all over what? The 5 million.
5 million.
That's all.
Hello, Prof.
Yes, boss.
Hey, please, I want to find out under which circumstance will, in computing the government mean take, will you subtract the additional interest instead of adding? Because there's this past question in the CIT past question set. I think one NI Exploration Limited and Nemo Petroleum Limited. In computing the government mean take.
Let me explain something.
Okay, all right.
Let me explain something. What you are going to subtract, okay? If they say mean take, you see the time I was trying to explain mean take, I was trying to say mean take meant something else. You remember? Now listen carefully. You see that additional interest when we are sharing the development cost. Do you remember?
Yes. Yes.
Do you remember the development cost?
Yes.
That apportionment we did where we had 50, 50, and 5. The government's portion, usually if you calculate it, you come and take it out of this total take. No? And the government total take minus the apportion development for the government. No? That gives you the mean take. You use that to come and do the mean take.
Oh, okay.
Once a government received money and he also spent money, which is the development cost that was apportioned to him. So you take that development cost out of the 1376026. Then you now come and get a mean take in revenue. Then you now take it as a percentage. So if the question comes this way, that find government total take in percentage, this is it. If they ask you mean take, then deduct that development apportion, the 5% that was apportioned to them from this. Then you now come and get the mean take.
Okay, sir.
That means,
Prof, please, the total
the
income.
You said?
Oh, come
The 5
on.
million. Did we assume the total income of 5 million?
No, I said we multiply the volume by the price of the crude oil. So let's say, you see, when I was doing the schedule, I established the schedule before I came to write the question. So we use $50.
Yes, please.
But it was 60, but it's just assumption. So this one by that gives you the total revenue that should have come from the
By the gross production.
operation. Yes. So that one, if you do all the government revenue, if you take it out of the total gross income, you should get what? The government percentage take. But if you want mean take, I told you deduct the allocated development cost to government. Do you get it? That's it. Yeah, mommy. Your hand is
Yes,
up.
please.
So, sir, does it mean that both the percentage and the development, the total take minus development is also mean take? Like both of them mean the mean take thing now.
Yes, that's if you have less the development cost. So
Okay, thank
you can have total take in Ghana CD and in what? In percentage. And you can have mean take in Ghana CDs and in percentage. But don't worry about that. I don't want to be confusing people. Because I knew the pass mark is just 50. I don't want to stress people. Just get your 50 and go. Sisi apo mo sua ade bebre. Say obetimi apo. You have to sleep so for over 4 months mo sua ade bebre. So the last thing I will want you to go and just read, because this one I think you get the whole idea now. Yeah. The last thing I want you to go and read before you sleep is read on stabilization agreements. Okay? Just know what they mean. Okay, so stabilization agreements are just agreement that frees the law, so that you are not affected by what any adverse changes in law. Do you get it? So petroleum operations, their laws are usually freezed, right? For minerals to the same thing, section 47 of the Minerals and Mining Act. So the laws are frozen such that, let's say, if adverse changes happen, okay, it doesn't affect you. So there are some companies who are still applying PNDC law 188 in the past. But if anything comes which is favorable, so we have two types of stabilization clauses, right? So the clause, we have what we call a freezing clause, which freezes the law at a point in time. Okay, that means that anything that happens after that law, you will not be affected, right? But this one, you cannot renegotiate it. It is what it is. Then we have what we call equilibrium clauses. Now, for equilibrium clauses, even after time passes, we can renegotiate the terms. So you see, maybe the time we did the freezing clause was passed, right? The interest, the petroleum income tax rate was, let's say, 35%. Let's assume. Do you get it? And now Ghana has brought a new income tax act, and petroleum companies are paying 20%. It means that under freezing clause, you cannot go and renegotiate this, right? But under the equilibrium clause, you can go and say, oh, I think what the new law has come is better. So let's sit down and renegotiate, and then let us now apply the 20%. Do you get it? So mostly they will tell you what a stability agreement or stabilization agreement is. Then they are also going to ask you the benefits and the disadvantages. Sometimes when there's an adverse change, there's a favorable change in law and you have a freezing clause, you cannot change, right? Then they can also ask you for development agreement under mining. So development agreements, this is where the mineral contractors agree to do a specific development by pushing some specific capital into the economy, a minimum of $500,000. Okay, so you can read on it. Then this question, thing capitalization. We've already talked about change in ownership, right? So go and read direct and indirect assignments. You know a bit about it. So thing capitalization, section 33. This one, very important. Everybody here knows how to deal with thing cap. Who doesn't know how to deal with thing cap? Who here doesn't know how to deal with thing cap? Hey! Okay, that means everybody knows how to deal with it. I said, who here doesn't know? That means you all know how to deal with thing cap. So that's it. Read it this night and go and sleep. This is it. Now, question one, you think capitalization, full calculation. Determine the interest allowable. Interest is allowed. Foreign exchange rate allowed. Okay.
Prof, can you do a quick example on that for us, just to refresh our mind?
Maybe not.
So look at this. Okay. So the whole thing is that interest in itself is an allowable deduction, right? But however, people take advantage of interest by taking loans from their related parties. The law says that if you take a loan from your foreign company or your sister company, right? And the loan is more than 3 times of your equity. Do you understand? I said the loan is more than 3 times of what? of your equity.
Your equity.
Yes, then any interest or foreign currency loss that came because of what? The excess loan shall be disallowed. Let me explain. So let's say that this guy went for an equivalent of let's say a loan of $100,000, right? From his parent company on what? On 1st January, right? When the exchange rate was 10 cedis to $1. Do you understand? Then on 31st December, the exchange rate now became what? 12 cedi is to what? $1. Okay. Interest on the loan was, let's say, 10%. Okay. And then they tell you that the interest and forex loss are already charged to P&L, right? They've already charged it to the profit. Okay. Then they tell us that the equity. Okay. So in tax, equity is only known as stated capital plus retained earnings. What did I say? In tax, equity is stated capital plus retained earnings. What did I say?
Stated capital plus
retained
retained
earnings. If you see
earnings.
any other reserve like capital surplus and those other surpluses, they are not relevant. We don't need them. Okay, it's only your stated capital plus what?
Retained earnings.
Plus retained earnings only. Any other reserve should be ignored for tax purposes. Makes sense. So we are saying that in this question, right? Let's say that their equity, under their equity, we had what? Stated capital. Stated capital, 100,000. Okay. Then we had retained earnings to be 100,000. Okay. So this is what we had in the question. Then we had capital reserve to be 300,000. So this is the information we have, and they are asking us to find our interest and foreign exchange loss allowed and II, interest and forex loss disallowed. And this is in line with section 33. Okay, think up. Now, how much loan did he go for the parent company? $100,000. At the start of the year, when the exchange rate was what? 10 cedi. But at the end of the year, the exchange rate became what? 12 cedis. So let's see if there was a forex loss. So one, I'm going to find if there was a forex loss, whether Maboka and foreign exchange loss. Let's see. So in that case, I can determine my forex loss and say that, okay, the loan was what? On 1st January, the loan was how much? It was $100,000 when the exchange rate was 10 cedi, meaning that this will become 1 million Ghana cedis. Mebwa?
Yes.
Okay, but at 31st December, it was the same 100,000, but now the exchange rate is what? 12 cedis. Mebwa?
Yeah.
Giving us 1.2 what? Million. So you were owing somebody 1 million. Now you are owing him 1.2. Waboka na wenyan faso.
Aboka.
Yeah, so there's a forex loss. And most questions will give you the forex loss, but I'm going the hard way, right? So that there's the good. So there's a forex loss of what? 200,000. Now, we now know that the foreign loan in Ghana cedi is how much? 1 million. No be so?
Yeah.
Don't use the one at the end of the year. It's one at the start because this has begun the year. And we said interest was how much? How much was the interest?
10%.
Yeah, so 10% of 1 million means how much was charged to the account?
100,000.
Okay, that means 100,000 is what has been charged to what? The account. Do you understand? Good. So the loan acquired was how much? In Ghana cedi?
1
That's
million.
1 million. No, not 10 million. It's 1 million Ghana cedi. Mebwa. But what's the equity? What's the equity?
You have to look at it and multiply by
Equity is stated capital plus what? Retained earnings.
Retained earnings.
We said stated capital was 100,000.
200,000.
Retained earnings too is 100,000, right? So that gives us what? 200 what? 200,000. But what's the allowable loan? We said how much loan is allowed?
3%. Hey.
So we said 3 times of
3
the equity.
times of the equity.
So 3 times the 200,000, right? So that's the 3 times the equity. So that means how much of the loan should be allowed? 600,000.
600,000.
Yes. So if we are saying that the whole loan of 1 million gave us what interest of what 100,000, me boy. So you are saying that let's try and find the interest allowed, and let's see something. How much of the loan is allowed? 600. But the total loan was how much?
1 million.
1
So
million.
if the total loan, which was 1 million, actually gave us interest of how much? 100,000.
100,000.
Then the allowable loan of 600,000 will give us what? We don't know.
It's
If less, more divide. So that means our allowed what? Interest is simply what? 600 out of what?
1 million.
1 million.
100,000. Do you understand?
Is it 1 million or 100,000?
No, it's 1,600,000, but I've cut 3 zeros off.
Okay.
So it becomes 600 out of the 1,000 times the 100,000 here. So is this the one you are finding over the one you know times 100,000? So that means this one gives us what? 60,000. Mewa. True or false? Is it not 60,000?
Yeah.
This becomes the interest that is allowed. So what's our interest disallowed?
40,000.
Yes. So our interest disallowed now becomes what? The total interest minus the allowed interest. No be so. So the total interest was 100,000. We take out what? The 60,000. Meaning the allowed interest is what? 40. This allowed interest is 40,000, which will be added back to profits. This is all about it. You can do the same thing for the forex loss. Let's try again. Forex loss what? Allowed. So forex loss allowed. The loan of how much? The total loan was how much?
1 million.
1 million.
Total loan of 1 million brought us foreign currency loss of 200,000. Okay.
Yeah.
So the allowed loan of what? 600,000 will bring us foreign currency loss of what? We don't know.
Don't know.
No be so. So if less, more divide. So that means our allowed forex loss will give us what? Will give us 600 over 1 million times the 200,000, which will give us what? 120,000. So what's our disallowed forex loss?
200 minus 120.
Yeah, so disallowed forex loss, which will be added to back to profit, will be what? 200,000 minus the 120,000, and that gives us what?
80,000.
80,000, which will be added to profit. So if the profit was given, let's say that the company, they had what? Profit before tax given as, let's say, 1.2 million. No be so? Then I now come and add back what? I now come and do the same things we did for mining or petroleum, right? So add back, let's say there was depreciation. So I add back the depreciation. Let's say this was what? 500,000. Then I'll add back what? The disallowed what? Forex loss. Do you understand? 80,000. Then I'll add back the disallowed what? Interest. No be so? How much was it? 40,000. Then I add back, I get what? 620,000. No be so?
Yeah.
Then now that gives me my adjusted what? Profit. No be so?
Yeah, 1.8.
And that's now what? 1,820.
1,820.
Okay, 1,820. Then you now come and less your capital allowance and your royalties. Do you get it? So 1,820. So we less what? Capital allowance. Let's say capital allowance was 820,000. So you take it out. You now come and get what? Your chargeable income, which is 1 million. And then you tax at 35%. It's 350,000. So this is all about think up. Very easy, right?
Definitely so. Hello.
Yeah, I can hear you.
Please, the forest loss. That one too, are you supposed to, is it 3:1?
Yes. So interest of forex loss is limited to 3:1. That's 3 times of the equity. That's why we said if 1 million was the total loan, the allowed debt is 3 times the equity. It applies. It's the loan that brought that forex loss. Without the loan, would there be any forex loss?
Yeah.
Do you get it? And this is only loans that come from related parties. So the question can also ask you ways to bypass thing capitalization. Okay. So you can use equity rather, or you can go with sales or lease back, or you can use back-to-back financing. If the loan comes from a bank, it will allow it. It won't be subject to think. So back-to-back financing means you acquire a bank who then acquires the subsidiary, or who then gives the loan to the subsidiary. So it's back-to-back financing or back-to-back think up. There are so many things in tax. I mean, you can't learn everything, but just get your 50. Okay. Now, leases have their definition under section 30. So look at the difference between finance lease and operating lease. Now, when it comes to finance lease, the treatment is that in the books of the lessee, okay, if the person is a lessee, one, the interest portion is an allowable deduction, right? The capital portion, he gets what? He gets capital allowance on it. Okay. And also, if the capital portion relates to a road vehicle that is not commercial, it shall be limited to what? The 75,000, you know. That's all. So if the question comes and it says that should they buy the asset or they should lease, you are now going to tell them that you think lease is better. Do you understand? Do you get it?
Yes.
Tisha, dear.
No, I didn't get it.
It's right on your screen. I said if it's finance lease, you get interest on the interest portion of the lease. Remember, if you lease an asset, you pay installment. So installment now you see the interest portion of installment is an allowable deduction. You shall deduct it from your expenses. Then the principal portion that you are paying for that lease is what?
Capital allowance.
It's capital allowance expenditure. You get it. Except when it relates to a road vehicle, you limit it to 75,000. That's it.
A commercial vehicle.
Non-commercial vehicle. Capital allowance, non-commercial vehicle. A vehicle that cannot carry up to 13 passengers or more than half a ton. These things you should know. It's a normal rule in Ghana. If you don't know that, it means you have not been learning. Because there's a normal rule in Ghana for road vehicles when it comes to capital allowance. Or you're all aware. Yeah. Look at this question. I'm showing you. There's a type of question. And this is the last thing I'll talk about. Because literally, it's like within these few days, I've taught you the whole syllabus. Can you imagine?
Prof, you didn't talk about the operating lease.
Operating lease is a normal rent. Rent canopy. What do? Do you get capital allowance? No. The only thing you get is the rental expense, right? As an allowable expenditure. Or true or false? Does it make sense? You don't get any capital allowance or anything. You are just renting somebody's asset. The rent is an expense, which is allowable. It's wholly, exclusively, and necessarily incurred because it's for the business. Aram Limited, this one came from February. Yes, February. Aram is contemplating applying for a license to operate the upstream petroleum sector. The management of Aram has approached you for advice on either taking a loan to acquire what? A floating production storage offload vessel, FPSO, on a lease agreement or acquiring it outright to support its operations. Lease and buying on your own. If you buy it and you own it, it's for you. True or false? So you get capital allowance, it's yours. You own everything. But if you go for a loan, you can go with if you go with a lease, you can go with finance lease or operating lease. No be so. So under section 30, you must define the finance lease that it provides for the transfer of ownership at the end of the lease term. You have the option to purchase the asset. The lease term will exceed 75% of the useful life. The residual value will be less than 20% of the market value at the start of the lease. And all the minimum lease payment, if you bring it to present value, it should be equal or exceed about 90% of the asset. And the asset must be custom made. Are you getting it? It must be a specialized asset such that only the lessee can be able to use it. So after that, right, the whole thing is that when it is a what? A lessee, are you getting it? At least the lessee will what? Get what? Interest on what? The interest allowability, right? On the interest portion of the payment, the installment. Then the capital portion, he'll get capital allowance for it. But if we go with outright purchase, right? You get capital allowance. Do you get the whole idea? And the loan you borrow to, you get what? An allowable deduction. Do you get the whole idea? There's no ongoing rental deduction, but when it comes to finance lease, what you are going to do is that one, the interest element will be what? An allowable deduction. The capital element, you get capital allowance. Are you getting it? If it is what? Operating lease, all that will happen is that what? You get the rental as what? An allowable deduction. That's all. And this question is 10 marks. So I believe today was not bad. So I already gave you what you have to go and read as last minute. So no excuses. 100% of the syllabus. 100% of the syllabus has been done. I hope it wasn't a bad session. Yes, you had you. All right. So
You've learned a lot.
That's it. Prof, are you going to have it the recording?
It's on YouTube. It's streaming live as
YouTube live. Okay.
So you can go to Profs Tax Academy. It's there.
Watch all this.
Yes, because we are not going to sleep, so one or two things then we refresh.
Please try and rest. Exam light of
yeah.
Please, I want the note. If you can share the note file.
So may the Lord be with all of you and make his face shine upon you.
Amen.
Grant
And
you
also
the grace that is required to shine. Nyame nti n'anim nkyerɛ mu nyinaa. Sɛ Nyame ti n'anim kyerɛ wo a, ɛyɛ dɛ, Papa. He said in Psalm 91, he will cause his angels to prepare the place for you. They will go before you and prepare the place. They will lift you so your feet will never kick against a stone.
Amen. Amen.
That wherever I turn, I shall prosper, and so shall my feet. Be blessed this day and every day of your life. Amen. Go and pass in Jesus' name.
Amen.
Receive it in Jesus' name.
Take this screenshot of the operating list in the last bit in Pacho. For sure, baby, mommy, why? Last minute we demanding.
But overall, how did oil and gas go?
Oh, Abuayempa, we should have had those things early.
Yeah, no. Okay, thank you.
God bless
you
and Prof.
Amen. Friday, international tax, we go again.
I thought we are starting tomorrow evening.
No, tomorrow, let me also have time for my final two people, I beg you. They are also going to write advanced taxation practice. No, I can't do that final one.
YouTube, there no be fun to your page no my.
Just go to YouTube and search Profs Tax Academy. It's already there. But you go to YouTube, Profs Tax Academy.
Okay.
Yes.
All right.
Like.
All right then. May the Lord be with you. So I'll see you guys Friday. All right.
Okay.
Make sure you subscribe, eh? That's one of my channels, my new channel. I created it yesterday. Yeah.
Okay, all right. Thank you.
All right.
Good night. Thank you.
You have international taxation. Tomorrow you can put it. Do you have videos on international taxation?
Of course. I've been teaching all these courses for 12 years. Why wouldn't I have?
No.
I've been teaching audit for the last 9 years. Advanced diploma in international taxation, both in the US and in Ghana. So international tax is my game. That's my best subject. The people I teach, they know.
Prof, I just joined. I don't have your contact. If I can get your contact.
Sure. My contact is 0243443934. Okay. So this is my number.
43443934. Thank you.
But go to the YouTube channel. You are not getting it.
YouTube channel.
Just go to YouTube and search for Profs S. One but S na Emma.
Oh, okay.
Profs Tax Academy. Profs Tax Academy. I have another one called Profs Accountancy Solution. I have Profs Digital Solutions and the rest, but this one is just for the tax. So you see some international tax videos too there. You can start revising with those ones. Or maybe I'll level the playlist. That's so many YouTube channels.
Well, where have you been all this while?
I'm always there.
Some of us we just encountered you.
Really?
We should have met you earlier.
Before the rest were we were.
That's okay. I really enjoyed the class. It's my first time though, but I've enjoyed the class.
The thing is, okay, there's a difference. I'm not a tutor. I'm a specialist. I'm a surgeon. The papers are my operating table. Okay. So when you have serious problems, that's when I come in. Yes, that's how I operate. So even the institute, when people have written and they can't pass, that's when they call me that Isimis Yabre, help him. So me, I'm not just a tutor. I diagnose, I fix. There's a difference between a normal doctor and a specialist. That's what distinguishes me from others. And you will see from how I teach. Yes.
Charlie,
and I've been teaching over 40 courses.
Xabi Alonso, even if Chelsea doesn't sign new players.
It doesn't.
So you are in good hands.
Academy.
It's okay. I'll get in touch with you after the exams.
I'm always at your service.
Okay, thank you so
much.
Yes.
One good news that I can give you is that if you want to do final 2, I'll recommend our class because nobody fails our final 2. They pass 3, and because of that, it's causing problem in the system.
Don't worry, you have a student now, so.
Yeah,
Who is that?
So, Prof, you do normal. You do normal class before intervention.
You do normal class. Most of the people on the call. I mean, most of the people on the call are my normal students.
Yeah.
In my normal class.
I see.
Just that nowadays I don't advertise on the platform. Okay. So the CIT platform, the main platform, I was taken off because of me displaying results. That there was one night 100 people sat in my class and all 100 passed, and I was posting it and so they took me off. And it's like I say, they show results, you are showing off. I saw you too know. So they took me off the platform for a while. So I wasn't advertising on the platform. I have other ways I do my normal adverts. That's how come nowadays I don't. But the platform now, because a majority of them old students.
As well.
Oh, okay.
Yeah.
It's
So
good. It's good we have met you. We'll keep in touch.
We'll keep in touch.
For final level 2.
Yes.
I did for you.
God bless you.
Where I stress people to pass, it's not easy. Stress need to be film. Stress.
It's worth it.
Yo.
Okay.
The paper that the final 2 people went to write, it has never come before. Most people were not expecting it, but my people, they were already prepared. So when they went, all of them, they said they were able to do it and do it well. Other people that they gave their numbers, they are calling me, they say, it's like they've gone to throw money away, so they shouldn't say that. Now you don't learn the topics in isolation. Do you get it? Now CIT is integrated.
Yeah.
Say, okay, me capital allowance embassa, yeah, the befra. That's the trick you should have. So all these little bits and pieces, learn to mix them. You get one question, they'll throw one leg of separate petroleum, they'll throw one leg of this, mix them up, talk on anything you see. That's all. So you'll be fine. May the Lord be with you.
I'll also be with you.
Good night.
Amen. Amen.
With your spirit.